Good morning, everybody, and welcome to ChartFest 2021. I'm Tom Bowley, Chief Market Strategist at EarningsBeats, and I just want to welcome everyone today. We are going to have a tremendous session. I'm looking so forward to this. I've been thinking about it, writing about it, talking about it for the last couple of weeks. It's such a pleasure to have a couple of great friends, great technicians here with us today from StockCharts. We're going to get into all of that in just a minute. I do want to make just a couple of very quick announcements. Then we're going to get everything going. For those of you that are EarningsBeats members, or for those of you that would like to be EarningsBeats members, we do have an event coming up on Monday evening. It's our Q3 earnings webinar. So we always do one of these each earnings season, just taking a look at some of the companies that have already reported great results with great reactions. You got companies already like Bank of America, Alcoa, JB Hunt. These were just three that reported this week, just absolutely superb earnings, great results, great reactions. So we're going to be looking at that. We'll also look at some of the companies that didn't report so well. And then we'll kind of put that those glasses on and get out the crystal ball and try and take a look ahead at upcoming earnings reports because we have so many earnings coming up over the next couple of weeks. And I'll be pointing out some of those that I think are going to be reporting great results as we move forward. We did a sneak preview of the Q3 earnings last week, and one of the companies I pointed out that I really liked going into earnings, one of my favorite banks, Bank of America. They came through, they broke out, the stock looking strong. So we're going to be doing that again on Monday at 4:30. You do need to be a paid member, but good news is you can be a trial member, so a 30-day free trial. But that is a member-only event. Tuesday, we have another event coming up, which is it's our ETF, our model ETF draft. So every 90 days, we put together a portfolio of ETFs and try to outperform the S&P 500. We are slightly ahead of the S&P 500 right now as we get ready to wrap up the latest quarter. But that'll be on Tuesday, so that's another member-only event. So make sure you check out the 30-day trial. We'd love to have you. Moving on. The session today is being recorded. So if you need to leave for whatever reason, we'll make sure that we still get the recording out to you. You can tune back in at your leisure, check out, the goings on of the webinar, and hopefully be able to just pick back up where you left off. As far as questions go today, we will have a Q&A period at the end with our guests. So if you do have questions, you can type those in, send them in. I cannot promise that we're going to get to everybody's questions because we do have limited time to try and get through everything today, but we'll pass along the questions to our guests and they can either answer in their leisure or maybe it could be a topic for a show coming up. So I'll make sure that they get those. And then today, the session itself is really just all about charts. It's about charting and it's about routines. So it's not just the charts. I mean, the charts are overwhelming sometimes. There's so many charts. There's so many things that we could possibly invest in. And I'm sure, I'm overwhelmed from time to time. So I'm sure all of you have that feeling from time to time. It's like, where do I put my money? Like, where do I go? How do I organize my routine to try to make the most out of the StockCharts website? So what we're going to be doing today, I know Grayson, Roze, and David Keller, who both are clearly experts over at StockCharts, they're going to share with you the way they approach the market, the routines they go through to try to organize using ChartLists and all the different tools and features at StockCharts. So really looking forward to the session. I'm going to bring in our first guest today, Grayson Roze. He is the Vice President of Operations at StockCharts. Grayson's a great friend of mine. We've known each other now for many years. I absolutely love his approach, maybe because it's similar to mine as far as the relative strength and some of the things that he uses, some of his tools. But he's got a very, very disciplined approach to taking a look at the market. I think everyone's going to enjoy this presentation. Grayson, it is so great to have you back. I know we've done a lot of these things over the years, and it's always fun to get back together. Welcome to ChartFest 2021.
Thank you for having me. It's so good to be here, Ty. I was thinking we've known each other for too long. We need to take a break. I don't know. We need to pause here.
Yeah, I always get excited when you get on the show, and then after 30 minutes, like, okay.
Yeah, sick of him. No, it's so good to be here. I mean, thank you for having me. Thank you for having Dave. Thank you for hosting this whole event. It's always fun to do something like this with you guys and speak to the EarningsBeats crowd. We love you guys over there, and yeah, just thanks for the opportunity.
Yeah, I mean, we obviously even before we really got into EarningsBeats, while I was working at StockCharts there as senior technical analyst for 4 or 5 years, I mean, all of my trading really goes through StockCharts. So
Yeah,
this isn't somebody who comes in and promotes something else, just because they're going to get paid or something. I don't get paid for anything that I talk about at
yeah.
StockCharts. I use StockCharts in my trading, and I know you and Dave have everything incorporated. The whole platform and the specific way you use it, you've got it incorporated into your routines. And I know you're planning to share that. I'm going to let you go ahead and get started. I will probably, give you like a 5-minute warning to kind of wrap up so that we can make sure we stick to the schedule.
Okay.
And then maybe go through some questions and answers before you wrap up. But take it away, my friend, get this thing started.
Perfect. I'm going to grab the screen. And does that work, Tom? Can I grab the screen for you?
Yes. Yeah. You go right ahead.
Okay. So, as Tom said, I love what you're saying there, Tom, about, running your process through StockCharts and everything. I mean, for me, I really do in a lot of ways feel like I have the dream job, because realistically, I mean, I'm a stock junkie. I'm an active investor, active trader. What I want to do is sit around and watch the markets all day. And the fact that I get to work for a company, sort of on the side in a way that's providing these tools, and I get to actually be a part of helping, build these tools and things. It really is a dream job for me, because in a lot of ways, I'm just sort of building the platform that I actively want to use in the market. And I know that the same goes for Dave, bringing new features to the site and things that he wants to use, new data. I mean, it's a dream for both of us. But to be able to share that with you guys and talk today about process, talk today about routines, those are the things that are near and dear to my heart. Ultimately, I mean, I think that you can have the best trading system in the world, but if you're not going to execute it, if you don't have the discipline and the routines in place to actually execute that system, it means nothing. So what we're going to talk about today is really kind of my process and how it runs through StockCharts. It really does all center around StockCharts. I have, other tools and resources that I do use. But for me, the bulk of my process all runs out of StockCharts. And the biggest piece of that, which we're going to talk about today, is using ChartLists. ChartLists, if you're not familiar with them, are basically just the organizational tool. It's how you save charts to your account. It's how you organize, watch lists, portfolio lists, market evaluation lists, all of that good stuff. So ChartLists really are, when people ask me, what are the most important tools and I really need to understand on StockCharts, it's actually in a lot of ways not the charts, as crazy as that sounds. Setting up your charts is an incredibly important thing, but setting up your chart lists, I would argue, is almost equally, if not more important. So really what we're going to talk about today is kind of how my process runs on StockCharts, specifically using chart lists. At the end of the show, we'll kind of get into, end of the presentation, we'll get into scanning a little bit. I'll show you how I run some of the scans, but even that touches the chart list features, because we're going to take those results and we're going to put them into a chart list. And we're going to use that to sort of review those results. So what we are talking about today, we're starting on a page that I like to call the heart and soul of StockCharts. This is the first page you see when you log in. It's called the members dashboard. As you can see, there's a lot of market data here. This is actually a great hub that I kind of use during the day to watch the markets, because if you think about what I've got on the screen, I've got a whole market overview here, which allows me to click through to different asset groups and then different indexes within specific assets within. I've got a sector summary. I've got different individual stocks moving, the S&P 500, the S&P 400. All of this is customizable too. By the way, Tom, that JB Hunt move was just crazy. Look at that pop. Anyways, yeah, the members dashboard is really a great place to go to just kind of watch the markets. But this is also one of the best places to go to access your chart lists. So this is why this is such an important page for me. So when I come to this page, most of the time I take a quick glance at what's happening in the markets, but I come over here and I hit this chart list button, and that actually scrolls me down the page to all of my chart lists. So I want to spend a little bit of time here actually before we dig into any of the lists. And I will say, by the way, we are absolutely going to fly today. We're going to cover a ton. I'm going to throw a ton at you. I'm going to talk about a ton, and we're going to move very, very quickly, because to go through all of the lists that I would love to go through in detail would probably take up the entire 3-hour session here. So instead of doing that, what we're actually going to do is a little bit of a giveaway. A whole bunch of these lists that we're going to talk about today, I actually have in a shareable format. So after the show, I know Tom and Aaron are going to help get these links over to you guys. You'll be able to actually pull up these chart lists, save them into your own StockCharts account if you want to do that. But a lot of the lists that we're going to talk about today will actually be shared with you. So instead of going through in great detail, chart by chart, we'll just kind of cover the highlights. The important part is the structure, really. What we're talking about is really kind of a top-down analysis structure that goes from the highest level of the market and a little bit of a longer-term view, looking kind of at weekly charts, as you can see up here. And we sort of drill down from there all the way down into the individual stock level, then down into individual portfolios and things like that. So really the key here is that we're talking about the structure that I use for my chart lists, how I've kind of organized everything. We're going to start here because it's a great way to kind of view everything all in one. So I actually want to walk through from here, and then we'll kind of get into more specifics. What we're talking about is something that I call my Sunday portfolio review. Sundays to me are the absolute most important day of the week, because that's actually when I do the bulk of my market reviews, the bulk of my portfolio decisions, the bulk of my trading decisions. It's all really on Sundays. I'm watching the market through the week, but I'm a busy guy. I got stuff going on. I got a full-time job. I got a dog and a house and a wife and all these things. So Sundays for me are really the time when I sink my teeth into the market and I dig into all of the different corners that I want to see. What you're seeing on the screen here is sort of the review structure, all of the lists that I go through in a very organized fashion every Sunday. This is what I call my portfolio review. Like I said, it starts with kind of the high level of the market, looking actually at weekly charts. That's this series of lists up at the top. Then I drill down into some similar charts, actually similar lists, but on a shorter time frame. So these are primarily daily charts. Some of these also indicate daily review. So actually this daily market evaluation list is something that I'll review every day. But then we'll drill down into the sectors of the market. We'll drill down into the industry groups. And then I have an organization for my portfolios. I have little nicknames for my portfolios, just kind of for fun. But we'll talk about how I actually have organized chart lists for each of my individual portfolios, and then how I actually combined those into a couple of lists that kind of bring those different portfolios together. So, let's say you have an IRA, you've got a 401k, you've got a couple of brokerage accounts. I have separate lists for all of those, but I also want to sort of bring everything together into one place. So we'll talk about how I do that at the end. But what we're looking at is the structure that I run through. And because I very carefully organize these lists, I'm going from the top down. I'm not jumping around from list to list. I'm not moving around my account trying to figure out where to go next. Every Sunday, this is the order that I go in. I start up here with my weekly market evaluation list. I go to the weekly global equities list. I go to the weekly US equities list, down into VTI and S&P 500 and the Russell 2000. And I'm just running down this column, basically going into each of these lists and carefully reviewing the charts that are in there. That takes me all the way down into the industry groups. And from there, the only thing left really is to evaluate my portfolios, evaluate the stuff that I actually own. So I'll do that. That's kind of the next group up. From there, you can see actually, if we go even further down, I've got some of my different stocking lists, new opportunities that I'm kind of finding out there, things that I'm keeping a close eye on, sort of my tier 2 watch list, if you will, even down into things that I'm actively considering buying. So that's kind of the structure of it. Hopefully that comes through here. This is probably the best place to see it on the site using the dashboard, actually. So again, I've got all of these lists carefully organized. Now, a little kind of StockCharts tip that I want to throw in here. Chart lists on StockCharts are always going to be ordered alphabetically. So if we go sort of further down here just for a second, all the way down, I got a ton of chart lists, by the way. you'll see that we've got a whole bunch of chart lists here that start with D. And then next up, we've got one that starts with E, one that starts with G, one that starts with S. So your chart lists are going to be alphabetical. But as you can see, I've sort of gotten around that by using different characters. So there is sort of a list of characters in a specific order that'll be prioritized ahead of the alphabetical order. So what that allows you to do actually is sort of custom order your chart lists. So as you can see, I'm going to go back up to the very top, scroll really quickly here. As you can see, the first thing that comes ahead of everything else is a little star, a little asterisk. So I've actually set what I call my tier 1 watch list, kind of my dump bucket for new stocks that I'm finding. That is the only list that has 1 star. And what that means is that it's always going to be the first chart list up at the top. That's helpful for saving new charts because that's basically always going to be the list that is selected. So it makes it a little quicker to dump stocks into or ETFs, whatever I'm watching, sort of dump that into my watch list. But from there, I've carefully combined symbols and numbers to create this order. I would highly suggest exploring this. If you're using chart lists, if you're interested in kind of creating a structure like this, this is a great trick that I learned many years ago. Some people do this with letters and numbers. Some people do this just with numbers. I personally like to use sort of a combination of symbols and numbers. But as you can see, I've got 2 stars and then a series of numbers. That allows me to organize these weekly lists. All of these are weekly lists. And the only ones that start with 2 stars are the weekly lists. The next up is my daily list. Those are the only ones that start with 3 stars. And I can sort of order those again after the 3-star grouping. I can order those again by putting in the numbers. So the point is, this allows me to really come up with an organization for my list, and it keeps things in exactly the order that I want to see. So again, the point of that is that on Sundays, when I'm coming in, I'm sitting down at the screen to review the markets, review my portfolios. I'm not kind of fumbling around my account, trying to pull up different lists. They're all just kind of right here for me. Makes it a lot easier to just kind of click through. So what we'll do now, I'll quickly run you through what I do on Sundays. That was kind of the mission for this show. Now, we're not going to dive into, like I said, all of the charts individually. This is going to really be kind of a breeze through, but hopefully it's going to show you how this kind of structure, how this kind of organization can help you. And we'll go again from the sort of the market analysis routines down into the individual portfolios. And then we'll actually have a little fun running some scans and looking at some results over in ACP, our new advanced charting platform. So that'll be a good time at the end of the show. So when I come here on Sundays, like I said, I go to the top of the dashboard, I click that chart list button, that scrolls me right down to here. I look for that weekly market evaluation list, and then I pull up the view as button. Now we've got a couple of different options that I use actually. Sometimes I like to use 10 per page. That is, as it's named, going to put 10 charts on the page at once. But more and more, I'm actually finding that I like Chartbook. Chartbook is going to put 1 chart on the screen at once and allow you to just kind of click through as if they're pages in a book and you're just sort of paging through all of the charts in your list. So I generally now start on Chartbook, and I'll come into, like I said, my weekly market evaluation list. That is the starting place. And this is where I go on Sundays. This is the first chart that I look at on Sundays. So again, the whole point of, just to reiterate this, the whole point of this structure is to start at the highest level of the market and drill down. We call that a top-down approach, top-down analysis. So I'm starting at that really high level. And as we go through, you'll see that I'm narrowing further and further into the markets. Eventually, I end up with my market analysis done, and I end up with some time to review my individual portfolios. And then from there, I can get into the fun stuff of searching for new stocks, keeping my watch list up to date, maintaining those, and finding new opportunities out there in the market. But so I come to my weekly market evaluation list. All of this stuff generally is a little bit longer term. So you see this is a 2-year chart here. We're looking at an intermarket chart. So this is kind of the classic intermarket view. We're combining a whole bunch of asset classes onto the screen: stocks, bonds, oil, the dollar, gold, different things like that, commodities here in orange. So this gives me a sense of how different asset classes are performing. Down below that, I have a couple of ratios. So this is bonds versus stocks. I have gold versus stocks, and I have commodities versus stocks. One thing that you'll see across my list a lot, since I know we are giving these away to you, I use VTI, the Vanguard Total Index. That is an incredibly important benchmark for me. A lot of people use the S&P 500, which is great. VTI and the S&P 500, frankly, are very close to each other. They're both cap-weighted indexes, and obviously the big stuff in the market has a real impact on something like VTI. But the strength of VTI is a couple of things. One, it's an index that I can actually buy. So instead of using something like $SPX, I can actually buy VTI. And in fact, I do. I own VTI. That's a position that I will probably have for the next 40 years just to have some exposure to stocks. But the other strength of VTI is that it brings in a little bit more from the market because it's not just large caps. It's a little bit broader. So I personally like to benchmark against VTI. You'll see that in here a whole bunch. But again, we're not drilling into the specific charts a ton today. We're just kind of reviewing the process. So if you're with Chartbook, what this allows me to do is just click from chart to chart. So once I'm done with that intermarket chart, I hit next, and I'm on to a global markets chart. So this is looking at VTI in blue there, which is the US. We're looking at VT, which is the black line. That is the total world. And then in the red line, we're looking at VXUS, which is the total world minus the US. So kind of a broad look at global markets. And down here, again, we're looking at VTI versus some of those other indexes. So the US versus the total world, and the US versus everything else in the world, if that makes sense. So that's what these ratios are below. So again, I'm just clicking through here every Sunday. I'm looking at emerging markets versus developed markets. I'm looking at the different market cap tiers. Now we're kind of zeroing in on the US market specifically, looking at the S&P 100, the mega caps, 500 large caps, 400 mid caps, the 600 small caps, and then in the orange, we actually have a micro cap index. Again, a lot of these have ratio charts on them. So I'm in this case comparing mega caps to large caps, mid caps to large caps, small caps to large caps, and micro caps to large caps. So kind of some relative strength there between the different cap tiers. And I'm flipping through here every Sunday. This just gives me a great opportunity to review these charts. One of the strengths of this approach too, because I have this organization, because I have these lists created, in Chartbook, I can do a couple of things. I can actually annotate these charts if I want. So you'll see that as we click through to, for instance, should be some annotations on some of these. But you can annotate the charts in here, which is great because you can kind of watch them evolve over time. You'll actually see that with one of the other lists that I spend a little more time annotating. But you can annotate those charts. You can watch these evolve over time, which is a huge, huge strength. And the other strength is that I'm coming back to the same charts every week. Now, it's a pretty fast process, frankly, because in some of these cases, there's not that much that's changed from week to week. But I know that I'm on top of it because I'm watching this every Sunday. And because it's the same charts, I know these charts so intimately, it makes it a very, very strong approach. So having this approach that you're coming back to the same charts every week, using the same charts to evaluate the market, over time, you build up a ton of experience with those charts. And it becomes a really, really strong process because you know exactly what to look for. You know what you're looking for. You kind of just have this intuition about the charts. That's what this process has really helped me develop. When I see something that's off, sometimes I don't even know it. I'm going through this whole process on a Sunday, and I just know that something is off because these little factors across all of these different chart lists, across all these different corners of the market, something has added up to be off. So anyways, I've got my weekly market evaluation list. I flipped through into some of the trend of the market, different groups, as you saw there with VTI, the S&P 500, 400, and 600. I get into things like breadth. So this starts to drill down into some of the strength beneath the surface. We've got breadth across some of the major groups, the NYSE, the S&P 500, and then NASDAQ. Then we also have an advanced decline line there on the NASDAQ. And again, I'm just clicking through these charts. We've got new highs, new lows, what's making new highs, what's making new lows. We've got advancers and decliners. This is actually a weekly view on advancers and decliners in the NYSE. We've got the same for the NASDAQ. We've got the VIX. I take a look at volatility every week to see where we stand on that all-important VIX index. Then we get into some offense versus defense metrics. So here we're looking at XLY versus XLP. That's discretionary versus staples. We can do that also in an equal weight flavor instead of the cap weighted flavor as the top one is. And two other ratios that I like to watch are technology versus utilities, sort of an offensive measure versus a defensive measure, and then biotech versus healthcare. So kind of an interesting one there because you've got sort of a segment of more of an offensive segment of a sector. So a couple of different ratios that I watch to judge offense versus defense. All these charts here are available to me every week, and these are the things that I'm looking at, the things that I'm studying. So again, we're not drilling into the charts. I want to keep moving as we go through these lists. But as you'll see here in Chartbook, it makes it really easy to flip through these. I can add my annotations. I can keep an eye on everything. And when I'm ready to move on to the next list, let's say I get to the end of this market evaluation list, all I have to do is come up here. And because I've got that structure in place, it's really easy to get to the next list. So here we're looking at global equities. We're looking at the total world. There you can see some annotations on here. And if I actually click annotate, you'll see that it's really easy to draw additional lines in here right from Chartbook. So it makes it easy to actually add my notes to these charts, draw some annotations, sort of keep things evolving over time. Here we're looking at a longer term view, a weekly chart of the total world, that VT index. I can flip through to a couple other sort of global equities indexes that I watch. We're looking again at VXUS, that's the total international index, everything in the world minus the US. We can flip through into the EFA index, which is Europe and Eurasia, a couple European side of the world. And then developed markets, we can look at that. We can look at emerging markets. So we're kind of drilling into some of those corners of the markets that we were actually evaluating in that first list. Next up, we go straight to the US. So I want to focus on, I am a US centric investor, obviously. And so I want to focus on the US specifically. So we've got a whole bunch of different indexes that I watch for the US specifically. Again, because these are part of the weekly list, these are all longer term views at some of these. So this is the Value Line Arithmetic Index, which represents basically the average stock. So we can look at what the average stock has been doing, clearly going sideways for the last couple of months. So this longer term view gives me some perspective on that. And I can keep flipping through, makes it easy. Here we're back to VTI, that important index that I kept talking about earlier. Things like the NYSE, we've got the NASDAQ up. I want to look at those two exchanges, see how both of those are trading overall. We've got the NASDAQ 100. We've got the S&P 100, now into mega caps, a longer term view at mega caps. Again, I'm flipping through all of these charts. So I get to the end of my US equities watch, which is just kind of, one chart for all of these different indexes. And there are a couple different groups, though, that I want to drill into. So the next step up for me is actually to go into what I call my VTI watch list, which brings in sort of a couple of different views of VTI. I mentioned that's an incredibly important index for me. So I have actually a very, very long-term monthly chart on VTI. And you can see this here. I have a weekly chart next up. I have a daily chart that comes up next. And then I have an intraday view actually that comes up next. So again, gives me kind of a couple of different views of VTI with that kind of drill down approach. I'm going from the monthly to the weekly to the daily to the intraday actually. This is an intraday chart there. Then I can look at a couple of different views of VTI. This is what I call my moving average focus. Basically almost hides the price bars. You can still see them there faded out, but keeps me focused on two key moving averages. Actually, a third one in there as well. The orange line is the 100-day that's kind of faded out. But the kind of intermediate term moving average, the 50-day, and then the longer term moving average, the 200-day. This view keeps me focused on the direction of those two trends, intermediate and longer term. So again, not drilling into all of the charts, but we've got a whole bunch of different views. So this is a 5-period moving average versus the 200 period, sort of takes out some of the noise, filters out a little bit of the noise from the charts. I've got a rate of change chart that I like to watch, just kind of keep an eye on how quickly we're moving on this important index. And then I've also got a Bollinger Bands view that I like to pull up for VTI. I repeat all of those charts for the S&P 500. So you can see, we'll pull this up. Here's that long-term monthly view, but we've got all of those same charts here for the S&P 500. I also bring in a couple of others. I do like to look at the S&P 500 in an equal weight versus cap weight comparison. So we can look at the equal weight version of the S&P 500. $SPX is going to get you to the S&P 500, but $SPX EW is actually going to get you to the equal weighted version. So kind of a breadth measure here. If we see the equal weighted version outperforming, that means that things further down in size, down the S&P 500, are actually outperforming a little bit. So here we've actually seen the equal weight index outperforming a little bit, trying to outperform after a long period of underperformance. So anyways, I've got a couple of additional views there on the S&P 500, but then I repeat the same thing for the Russell 2000. Again, those same charts for the Russell 2000, looking at small caps. So for instance, we can see on our moving average focus chart, this is one I've been focused on quite a lot recently. We can see that intermediate term trend is just very, very flat, very, very sideways. This is the benefit of this view. It gives me a clear look at that, but we can see that it's kind of running up against a longer term uptrend in the 200-day moving average, which is starting to kind of roll over a little bit as this 50 flattens out. This price action on the Russell 2000 has just been so flat for so long. But anyways, I've got that Russell 2000 watch list up next. Now, when we open this up, we'll kind of scroll through a little bit quicker. I look at the US sectors in a weekly view. That one is a little less important to me, I will admit. I typically want to watch the sectors more on the daily charts. The same goes for the US industry groups, the Dow Jones industry groups, which is kind of the next level down after the sectors. I typically want to watch those on a daily chart as well. So I do have weekly lists for those too, but typically I actually skip over them. I will admit, I typically skip over them. There's something that I come to maybe once a month. I'll take a peek into to those lists, but I do have them for myself. Now I have that daily market evaluation list that I mentioned. So this is actually a list that I will review pretty much every day. This is kind of one of my go-to charts after the market closes. It's very, very similar to the weekly list, but has some modifications and the time frame is a little bit shorter. So here we're looking, for instance, at that intermarket chart, but it's a much shorter time frame. We're looking over the last 6 months. We're not looking over the last 2 or 3 years. So here we can see that oil has been outperforming. Commodities have been on a huge, huge run. And we can see that reflected again in some of those ratios where we have bonds versus stocks, we have gold versus stocks, and we have commodities versus stocks. So similar things that we have up here, global markets, developed versus emerging. I'm just kind of taking a narrower term view, narrower look at some of those things. There are some things that I bring in, like for instance, something that Dave Keller talks a lot about, new Dow theory. I have a list or a chart for that I look at typically every day. We've got advancers and decliners. That's an important one on the daily. Works even a little bit better than the one on the weekly. And then there are a couple other things that I'll bring in here as well. But again, I've got that daily market evaluation list, which I will still look at typically on Sundays because it's right there for me. I've got this whole organized structure, makes it very easy to pull that up. But I'll run through all of those charts and then I kind of repeat that same weekly process, but on a daily chart. So I run into the global equities list, the exact same symbols in this list, but instead of looking at those 5-year weekly charts, here we're looking at 18-month daily charts. So it's a little bit different. But again, we've got that total world, we've got the total international, EFA, developed markets, emerging markets, even frontier markets in here, a whole bunch of things sort of more broadly outside the US. Then we drill into the daily US equities lists. Same kind of thing. I'm here in Chartbook. I'm flipping through these. Here we can take a closer look at that average stock that's really just been going sideways as we saw on the weekly chart up above or previously. So, this gives me a narrower view, sort of a closer in view, a zoomed in view at some of those things that I'm seeing in those weekly lists. And I keep flipping through here. This is an important list for me, especially on a daily basis, watching where we are. Gives me a great look at kind of where the markets are currently trading. And it is a little bit zoomed out. These could be even narrower, but I actually get to that in just a minute, as you'll see. So I like to keep these at about 18 months or 2-year charts. Gives me a little bit more perspective instead of always looking at a 1-year or narrower chart. But the concept is the same. I'm running through those same US equities. I'm here in Chartbook. I can annotate these charts. As you can see, here's some annotations on the chart of the NASDAQ, things that I've been watching closely. So I've got that list available for me. Now, as I mentioned, instead of having these charts be a little bit narrower, I actually have additional lists with narrower charts. So I have a list that's next up that's a 6-month chart for some of the major US indexes. Not all of them, not all the same ones we had in the list before. These are kind of the ones that I want to focus on. So as you see here, we've got VTI, that's the total market. Then we have the NYSE and the NASDAQ. We have the NASDAQ 100, and then those S&P indexes. So mega caps, large caps, mid caps, and small caps. Now for these lists though, it's the same concept. I'm running through these in Chartbook. I can add my annotations, makes it really easy to see. And these are a little bit narrower. So here we're looking at a 6-month, 60-minute chart. So each bar represents 60 minutes of trading. I do the same thing for a 3-month chart. This is going to be a 30-minute 3-month chart. We can do the same thing for that same list. So again, I'm kind of drilling down further into these indexes. Next up, I have a very narrow time frame. For me, this is a 45-day chart. Each bar represents 1 minute of trading, so 45-day 1-minute chart. So this gives me a great insights into the intraday action, how things are really trading. I mean, here we can see VTI bouncing off these levels quite a lot, sort of making that breakout above where it had tested before. This nice pop here earlier in sort of late last week. Gives me a look at accumulation distribution as well. So we can see that even though we've been trying to bounce here on VTI, there's a lot of selling going on in the market, has been for a while, and we're not really seeing accumulation distribution pick up. So I can sort of drill into some of those things across some of these indexes here with this narrower term list. Now, once I get to that, I want to go from that market level down into the sector and the industry level. So I have a couple of lists that help me do that. First and foremost, the most important one is my US sectors list. Now I have a list for this, which allows me to do a couple of things. I do keep the S&P 500 in here through SPY though. So not the $SPX index that we have on the site, but actually through SPY, which is a tradable ETF. Again, I personally like to benchmark against things that I can actually buy, things that I can actually own. So in this case, I like to benchmark against SPY when I'm looking at the sectors, because that's an index that I can actually own, an ETF that I can actually own. So I take a quick look here. This is actually a 1-year chart. Take a quick look at the S&P 500 itself. Gives me a little bit of perspective before I drill into the sectors. But then from there, I can click through. And as you can see, in this list, I have all of the S&P sector ETFs in one place. So it makes it very, very easy to just click through the different sectors. I have all of these compared to the S&P 500, SPY, up at the top. So I'm watching these relative strength lines. I'm also looking down here at the scooter values to see which of the sectors are the strongest from a scooter score perspective and also from a relative strength perspective. Again, we want to own the things that are outperforming. We want to own the things that are strong, own the things that are working. So I want to see these relative strength lines going up, not down as they are here. So communication services, not looking great, trading below some key moving averages and underperforming the S&P 500. I'm going to move on to the next one. Consumer discretionary, a little bit of a different story, making a beautiful breakout this last week. A long-term uptrend here, had been underperforming, but is now starting to flip that. And we're seeing some relative strength coming out of consumer discretionary versus the S&P 500. When we look down at the scooter score, we can see that it has been rising and we've got a strong scooter score. That, by the way, is our StockCharts technical rank, something that I use quite frequently. But anyways, this list allows me to drill into the sectors of the market. Now I'm going to move on because I've got a couple other lists that are similar. The sectors of the market are very, very important to me. The US sectors list that we were just looking at is all cap weighted sectors. They're cap weighted ETFs. So what about an equal weight version? Well, we can do the same thing here. We actually have equal weight versions of the S&P 500, as we talked about earlier, but we also have equal weight versions of all of those different sectors. So something like consumer discretionary, we can see here, this is actually the equal weight version instead of the cap weight version of consumer discretionary. We can see here, been going sideways for a little bit longer. So in that space, in consumer discretionary, we're kind of measuring breadth here by looking at these two charts. We can tell that the breakout that we're seeing in XLY, the consumer discretionary version that is cap weighted, that's really among sort of the big players in the market, because we're not seeing that as much out of the equal weight version. Still kind of going sideways, has yet to make that breakout. We can also compare the scooter scores. We can see the equal weight version, actually a lower scooter score here. So this gives me a sort of a different look at those different US sectors. Then I have actually a weighting comparison which we won't really get into, but this allows me to actually compare, for instance, consumer discretionary cap weight versus equal weight. I've set these charts up to do some interesting comparisons between those two flavors, as I like to call them. I've also got a US sectors list that combines the cap weight and the equal weight into one list. So that's kind of the ultimate list, putting all of that into one place. Now, finally, on the market evaluation side, we've got our US industry groups list right here, which allows us to drill down into all of these different US industry groups. There are tons of them. I think there's about 104 of them published by Dow Jones. This is the industry group level that sits kind of below the sectors. So I do have a list that allows me to go through all of these. This is something that I actually don't typically go through all of the charts for. I'll generally look at this in summary view. We're going to flip over to summary view here, which allows me to look at just sort of a data view of this group. Now I can sort this by scooter, which puts the strongest sort of technical leaders up at the top and the weakest charts down at the bottom. So we can see something like Brewers, for instance, is going to be a very, very weak chart, but we can see something like coal, going to be a very, very strong chart. So the scooter score helps you sort of filter that out really quickly. I can also come over to the summary page though, and do something like over the last 3 months, what have been the top performers? I can change the period to 3 months. I can sort this by percent change from top to bottom. We can see that over the last 3 months, aluminum has actually been the strongest, the biggest gainer among those industry groups. So this is typically how I look at that industry groups list. And when I want to drill into something, maybe like coal, I'll actually just open that chart specifically. I'm typically not from week to week flipping through all 104 industry group charts at once. But one thing, while we're here on the summary page, one thing that I do want to mention is a little feature called the Send Daily Report and the Send Weekly Report. So for some of these lists here, for instance, in our daily US equities list, I've actually turned on these daily and weekly reports. Now, what that's going to do is take all of the price data, take all of the performance data for everything in this list. And at the end of the day or at the end of the week, you get to choose, one or the other or both. We will send you an email that summarizes the daily or weekly performance for everything in this list. So it's a nice little summary. It's a daily report of what happened in this list. I've set this up actually for some of my market evaluation lists because every day and every week, I want to know what happened across all of these different US equities, US equity indexes. I've done the same thing for instance, the US sectors list. I actually have a different list that I have in my account that turns those on. But I have a chart list in my account that's got all of the sectors in it. I have one that actually takes out the S&P 500 for emailing purposes. So it's kind of a dummy list. But I've set that up on that other list to turn on the daily and weekly report. So every day I get an email that says, here's what happened across all of the 11 sectors in the market. And at the end of the week, I get an email that says, here's what happened for the weekly performance of all of those different sectors. It's very easy to turn these on. All you got to do is click and then choose your timing, depending on the market that you're watching. So very easy to turn those on, but definitely something to highlight, especially when we get into the next section, which is your portfolios. So we'll open this up. This is kind of another view at those chart lists. But as you can see, we've gotten all the way down to that to the bottom of that block that we were looking at the start of the show. We've gotten down to the bottom of our US industry groups. So at this point in my Sunday portfolio, if you're kind of looking over my shoulder, I've gone through all the different corners of the market. I've drilled down from the top of the market down all the way into the industry group level as well. Now it's time for me to say, okay, I know what the market's doing, but what about the stuff that I actually own? What about my portfolios? So that's where I have my portfolio lists. So for instance, we'll pull up my Lauriston list. Here you can see in summary view a few of the stocks that I own. This is one of my stock portfolios, individual stocks that I actually own right now. I'll look at this in summary view. Again, I've got those daily and weekly reports turned on. So I'm getting those reports sent to me via email every day and every week, a very, very helpful tool, especially for your portfolio lists. But I've taken the stuff that I own and I've created a chart list for it. Now, in my case, again, I've got different portfolios. I've got an IRA, I've got a 401k, I've got a couple of different brokerage accounts. So I have different chart lists for all of those different accounts with my silly little nicknames. So I've got individual lists, which is what we're going to walk through right now. But I've also, like I mentioned earlier, combined those into some sort of master list, if you will.
Hey, Grayson.
So, yep.
We probably, maybe if you can maybe take another 2 or 3 minutes. We have a couple of questions, not a lot of questions. So maybe you can go a little bit longer, but maybe if you can wrap up the next 2, 3, 4 minutes, that'd be good.
Sure, we'll fly here really quick. So the point is really not to drill into any of these charts. These are just kind of the things that I own. But the point is that I've created these chart lists for my different portfolios, something that I highly, strongly recommend. And again, I can view those in Chartbook. So it makes it really easy every Sunday to breeze through the charts of different things that I own. I can just kind of click through. We're looking at a chart of Amazon now. We're looking at a chart of Bill.com now. Again, because I've got those portfolio lists organized, makes it very easy. After I've come down to the bottom of my US industry groups list, I can just sort of step into my portfolios and again, keep flipping through the charts of the stuff that I own. Now, I mentioned that I put everything together into some different lists. So I've got the sort of core charts that I watch for each of those portfolios. But as I mentioned here, I've got actually different groups to the things that I own. So I bucket things into different categories, core and explore, and something else called super core as well. But I've got some different groups for the core positions. I actually have a daily list and a weekly list. So the key here, what I would recommend is take your positions, put everything together into one list, and set everything to be daily charts. That's going to give you a look at the daily charts for everything that you own. You can then take that list, copy it, take all of those different holdings, copy those positions into a second list, and make that second list weekly charts. So when you want to pull up a longer term look at the things you own, you'll have that weekly chart list available. So for instance, we'll see this really quickly here. In the weekly list for what I call my explore positions, these are long-term weekly charts. These are 5-year weekly charts. It's a similar concept to what we were doing with the US equities up above. This is kind of a longer-term view at some of the things that I own. Here's a longer-term view at Adobe, a 5-year weekly chart of Adobe. We've got next up a 5-year weekly chart of Amazon. So I've got that weekly list with all of the different stocks that I own, but I've also got the same thing in daily flavor. So here are the daily charts of all the things that I own. This is a 1-year daily chart. Now we're looking at a 1-year daily chart of Adobe. So similar concept to what we did before, having the same list with weekly version and the same list with a daily version. I have also combined everything into one chart list that I call all positions. So this is every single position that I own across all of my different accounts. There are a couple benefits to that. Again, one, you can come over here to the summary page. You can turn on that weekly report. This is a nice way to get all the stuff you own in one place. But we can also run scans on that. We can do some very, very interesting things with that. So that really is kind of the end of my review process. I've gone through the markets. I've gone through all of my individual stocks and ETFs and mutual funds, everything that I own. I've gone through those portfolio lists. And the next thing up for me would be to go through some of my stocking lists, run some scans, review some scans. I actually do something kind of interesting here. We might run out of time to show it, but I'll mention it really quickly. I have a couple of lists here for scans that I run. Or for instance, I have a chart list for all-time highs in the S&P 500. So I have a scan in my account, part of my kind of daily process. I have a scan in my account for all-time highs in the S&P 1500. I run that scan every day after the market closes. I then take those results and I merge it into this chart list. When you merge things, it basically says if this symbol doesn't exist in the chart list already, we'll put it in there. If it does, we'll ignore it. So when you merge everything into the same list and you run that every single day of the week, what happens is that because I've done that Monday, Tuesday, Wednesday, Thursday, Friday, by the time I get to Friday and I run that scan and I merge those all-time highs in the S&P 1500 into that list, I'm left with a list of all the stocks that made an all-time high that week in the S&P 1500. So here you can see, I think there are about 143 this week. All 143 of these stocks made an all-time high in the S&P 1500 this week. So as I go through my portfolio review, I get to the end of it this is the place that I go to find new opportunities in the market. This is ultimately the best filter for me. Stocks making new all-time highs. There is not a lot that is stronger than a stock making a new all-time high. And not every chart is going to be set up absolutely perfectly. We are going to have some laggards in here that are still, cooking their way to all-time highs. But this is a great place to go to look for me. A couple of filters on there, the all-time highs, but also things that belong to the S&P 1500. That is the 500, 400, and 600 put into one. That itself is a great filter. Anything that's in the S&P 1500 is kind of a great filter. So I've got a couple of filters on there, but this is one of the processes that I have to find new stocks. What we were going to show is actually how to run this out of ACP and then filter through those lists really easily, because it's very easy in ACP to click through scan results and just get the charts right away without having to sort of go through one at a time. But I think Tom, we might run out of time for that one. But hopefully that comes through, that I'm running that scan every day and I'm merging those results into the same list. I do the same thing actually with new 52-week highs too. So all-time highs and new 52-week highs, very similar, but not exactly the same. So as you can see, I've got a couple of different lists for that help me do that. So I've got a couple of scans that I run after the close every day. And then when I get to the weekend, that's when I can really sort of drill into some of those lists and find some new stocks that I might want to put on some of my watch lists. That's where most of my my new trade ideas kind of come from. So
Sweet. Excellent presentation.
We flew.
Yeah, I mean, you got a lot of chart lists and a lot of charts and so forth. So trying to get through all of it, I know, is pretty challenging in a fairly short period of time.
Always.
Yeah, before we go into the questions here, I just want to go over, because we're going to be sharing some of our chart lists with the folks attending. So what chart lists are you talking about sharing with our audience?
That is a great question. It's a whole bunch of these ones, and I don't know if it's the full list. I've got a few of these in a shareable format. So I know for a fact that it is the weekly market evaluation list. I believe the weekly global equities and US equities lists are going to be shared. And then some of these daily lists as well. So the daily market evaluation, probably the daily global and US equities list, and then the US sectors list I know is in there. So yeah, I will share that with you guys and make sure that we get that into everyone's hands, but a whole bunch of these are shared. I will also say, just to add to that, in case you're kind of wondering what else is in some of those, we actually did an episode a few months ago of my show on StockCharts TV, which is called StockCharts in Focus, more of a product focus show, just kind of running through, different features of the site and different things that are new. But we actually did an episode of the show that was kind of going through something similar to this, reviewing some of my personal chart lists. So if you search YouTube for Grayson Roze personal chart lists, it'll probably come up. That might give you, it might actually have some links in there as well. But that'll probably give you an idea of what's in some of these other lists if you're curious to kind of do this again.
Yeah, this, by the way, this shared chart list feature that StockCharts has created is absolutely awesome. We use it significantly in our business at EarningsBeats.com. That's how we get a lot of our research down, to our members through the shared chart list feature. If you're not a StockCharts member, and you can correct me, Grayson, but if you're not a StockCharts member, or if you're a basic member, I don't believe you're going to be able to download these lists. Obviously, if you don't have an account, you can't download, but you'll be able to view the charts, number one. If you are a member, you can take these chart lists just as Grayson has them and download them, rename them, whatever you want to do in your own account, but you can download the entire list right into your account. It's a great reason to check out StockCharts, to sign up for a 30-day free trial and just see what it's all about. I'm telling you, once I started using the StockCharts site, I never went back. I stopped. I used to have a Schwab account years ago, and I used to do my scanning, and I used to do a lot of stuff through their pro system. I forget what it was called.
Yeah.
Schwab Pro, or I don't remember. Right. And I started using StockCharts, and I don't go to my broker for anything anymore. I literally spend my entire day on StockCharts. It's really cool. If you haven't tried it, I would seriously encourage you to try it. So that's going to be my spiel there for StockCharts. But these shareable chart lists are really cool. So, and I want to make sure everybody can take advantage of that. We do have a few questions here. Well, we got a lot of questions. You're not going to be able to get through all of them, maybe, but try to get through a couple of these quickly if we can. One question came in early. When you were going through your breadth charts, what do you look for? What do you specifically, what does Grayson look for on the breadth charts?
That is a great question. And you know what? Since we're in here and I got the screen, why don't we pull one of them up? I'll do chart book. This is the other benefit of chart book. Actually, it allows you to get to a specific chart. So 10 per page, you kind of have to scroll around and know where something is. But in chart book, you can pull it right up. So here we are. We're looking at breadth on the NYSE, the S&P 500, and the NASDAQ. I'm looking at a couple of things. One, this is actually a crazy, crazy chart. This is a 10-day sort of rolling moving average of new highs minus new lows on the NYSE. This actually, for the first time ever, I believe, has not dipped below zero in 2021. And it looked like we were going to do it there, but it's actually been picking up now. So I'm kind of watching that. Mostly what I'm looking at are specific levels. I'll actually, scroll. Typically when I come to this chart, I'll take a quick note of that, and then I'll scroll down a little bit further. Just to run through this so everyone knows, we're looking at the NYSE in blue, the S&P 500 in green, and the NASDAQ in purple. But within that, we're looking at the percentage of stocks above their 200-day moving average. That's the top panel for all three groups. And then the percentage of stocks above their 50-day moving average. So again, on the NYSE, the S&P 500, and the NASDAQ. I'm looking at specific levels. And as you can see, I've actually set this up so that there are some lines going across at 25%, 50%, and 75%. So I'm looking for breadth bounces, basically, things like this. I'm looking to keep an eye on the number, and just kind of that generally informs me about the strength of a move. So for instance, when we're seeing, the S&P 500 making new highs, as we've been seeing for a while, but we've got the percentage of S&P 500 stocks above their 200-day moving average has been downtrending that entire time. I mean, that's just kind of a point of concern for me. So I am just kind of looking at the numbers and keeping those numbers in the back of my brain, I guess, as I'm going through other charts in the market. I mean, this is another one. The percentage of stocks in the NASDAQ above their 200-day moving average has been in decline for really almost all of 2021. So I'm taking note of things like that, but I'm also taking note of bounces at important levels. So for instance, I mean, here on the percent of stocks above their 50-day moving average on the NASDAQ, we've seen that 25% level actually be a pretty important bounce spot a couple of times. So I'm keeping an eye on that. And I will say, I mean, I watch these charts over time, like I said, every week. So, at a time like the big collapse that we had, at the start of 2020, when we see breadth numbers getting down to, basically zero, that can be kind of a bottoming indicator. Just because those are exhaustive moves that you're not going to see that be sustained for months and months and months and months and months. So I'm looking at a whole bunch of different things on these breadth charts. The first and foremost thing, though, is just kind of the numbers. Where are we? Is this a really, really strong move like we saw back here at the end of 2020 when we had these crazy, crazy breadth numbers? As Tom McClellan likes to say, we had gobs of breadth, percentages up there in the 90s. Versus now, when we're kind of more in the middle. We're somewhere in the middle. We're starting to recover a little bit, but we're somewhere in the middle.
Okay, very good. How about there were at one point you were showing the percentage change shown on your owned positions, and the question was, is that a percentage from purchase price? And if so, how do you add that? But I think it was over a period of time. But
no, that was just a period of time. We'll pull that up here. I'll go back to summary view. So here we have this period menu. When we say intraday in the summary view, that just means the latest day. So in this case, we're actually looking at Friday. So what did all these positions do on Friday? We can change this, though, to be percent change over however many months you want, however many days you want. So for instance, we can look at year to date. Here we're looking at the percentage change year to date on some of these positions. So that's what that is. It's not a customized from purchase or anything like that. It's just over a set period of time.
Okay. Here's another question. And we got about a minute and a half to go.
Okay.
How do you work with ChartLists between ACP and SharpCharts, since the same chart list can't be tweaked in both places?
That is a good question. There's a little bit of manual labor that you got to do to maintain them. But one of the tricks, actually, I will pull this up very quickly. We'll run over to ACP. One of the things that I find myself using a ton, because I do have obviously a lot of my process set up here in sort of the sharp charts world, over in ACP, because you have this little tab here, when you open up that chart list panel, you've got a little tab for sharp charts. This actually means that I'm able to work with all of my sharp charts lists. So for instance, we'll pull up that Lauriston list that we were looking at, and I can set this ACP chart to be whatever I want. I can set it to be some wacky chart style, something that I'm working with in ACP. And I can actually check load symbol only, which means that anything I click out of this panel, we're not going to pull in the sort of sharp chart style. We're just going to pull in whatever the ACP style that I have on the screen is. So for instance, let's actually do this. I'll show you exactly what I mean by that. These are going to be fairly similar, but here we have basically a sharp charts version, an ACP version of the saved sharp chart that I have up. But if I change this ACP chart to be something like, I don't know, let's do Bollinger Bands. So now I've got a different ACP chart. And if I check load symbol only, and I do that same symbol, so now it's actually going to sort of override whatever that sharp chart style is. So point is, this makes it really easy to work with your sharp charts lists in ACP. I actually find that I do this a ton. So for reviewing my my portfolios and things like that, it's really nice to have this available to me. So that's one trick I would say. But if you do want to kind of maintain things in both places, there is a little bit of manual labor that you got to do to keep those up to date. But some tricks like this sharp charts tab are really important. And I will say before we wrap up, we're actually doing a whole update in the next couple of weeks to this drawer, which makes it really easy to work with your chart list in ACP. This is actually going to get even better, and we're going to have sharp charts features sort of in here in the drawer, something kind of similar to what we have in the sidebar panel. So keep an eye out for the improvements to the drawer that are coming out in the next couple of days, really.
All right, final two comments or questions. One question, there were multiple questions about the shared chart list and how folks are going to get them. We're going to actually put it on the page where everybody, the event page that everybody could kind of see. We're going to later update that, so you'll have all the links there, and we'll let you know. We'll send out to our entire community, everybody that's in here. We'll get some kind of an email from us saying, hey, click on this link, go to the web, to the page, and you can now download or view all of these chart lists that Grayson and Dave and I will be sharing today. So just want to let everybody know that. And then the last comment, I got this question in from this guy named Dave Keller, who said,
"Get him out of the room."
Yeah, it's nice to see that he's inspired you so much over time. So I think we have Dave coming in. But first, Grayson, I just wanted to thank you. A great presentation. Everybody was commenting saying this is awesome. Some were saying I wish it was a lot longer, because there's obviously so much information to try to talk about and how you set it all up and everything. But,
well, I will say just really quick before we wrap up, before I hop off, if anyone has questions, anyone wants to get in touch with me, one of the best places actually is Twitter. If you're on Twitter, go find me at Grayson Roze. Send me a DM or whatever. Always available there, and always tweeting stuff, charts, and having fun there. So feel free to reach out to me there. But yeah, thank you all for watching and being here, supporting us, supporting EarningsBeats and Tom. I know it's hard to support Tom sometimes, but we gotta do our best to keep him off the streets. So
keep me happy, please. Yeah, one last comment. Just make sure if you're tweeting Grayson, last name is with a Z. Roze with a Z.
Grayson Roze with a Z.
That is it. We got about 2 minutes. We're going to take a very quick break. I know Dave is here. Dave, actually, if you want to just test your mic, make sure we can hear you.
Hey, Tom, Grayson, how are you guys?
Awesome. You sound great.
No, you sound awful.
Yeah, you sound much better than Grayson.
Oh, come on.
All right, we're going to take about 90 seconds. We're going to get started, Dave. Just hang in there, everybody.
I'm good.
Okay, welcome everybody. Welcome back to ChartFest 2021. We just had a great presentation from Grayson Roze, Vice President of Operations over at StockCharts. I hope you enjoyed that presentation. Grayson is going to have some chart lists that he is going to share with all of you. We'll certainly let you know when that's available. We're now moving on to the next presentation. This is with David Keller, who's Chief Market Strategist at StockCharts.com. Also, Dave is the host of The Final Bar. Many of you probably listen to him over at StockCharts TV. That airs at the end of the market day every day, 4 o'clock Eastern. Dave is a great friend. I love the show. I consider The Final Bar to be the flagship show over at StockCharts TV. He's got a great routine that he goes through. And I think when you approach the stock market, you've got to have a process. You've got to have a routine. You know, listening to the show, it's very similar every day and the way he goes through his process of going through the show. Anyway, I really enjoyed it. I'm sure many of you do as well. We are really honored and privileged to have Dave joining us today. It's always a pleasure to get together and share some of the things that we've learned over the years. Dave, it is really a pleasure to have you today.
Thank you, Tom. I appreciate it. No, this is a lot of fun. And you did not mention that you graciously guest hosted the Final Bar last week, which was very much appreciated. So I could go on vacation with my family. So thank you for that.
Yeah, I was trying to go through a little bit the way you do. I was like, all right, I can't do this. I got to go. I got to shoot all over the place here. But hopefully you got well rested and you had a nice family vacation.
Good to go. Yeah, we went down to Mount Hood, which is in sort of northern Oregon, which is just this beautiful place. I mean, just lots of space, beautiful views, good weather. It was very, very, very nice.
Awesome. Well, I'm not going to take any of your time. I know you've got a routine that you want to go through. The whole idea is if you're new, you're just walking in here to ChartFest 2021. What we're trying to do is we're going to obviously go through a lot of charts, but it's also about the routines and the processes that we go through to try to make better and more informed trading decisions or investing decisions. So you heard from Grayson, one of the experts over at StockCharts.com, and now we have another, Dave Keller. Take it away.
Appreciate it so much, Tom. And I actually really enjoyed watching Grayson. It's funny, we're both at StockCharts and we work together in a lot of ways, but we not often enough get to see each other present. So it was actually really fun to hear Grayson's take. I actually, to be honest, and I hope Grayson is off so he doesn't hear this part, but I was super impressed. I actually took a page of notes of ways that I needed to upgrade my own chart lists. So I'll try not to let Grayson that get to his head too much, that I was impressed. But I thought that was really, I've learned the same thing. When I was starting to use the StockCharts platform, it was a little overwhelming only because I've, spent a career using a lot of different charting platforms. And I actually started my career at Bloomberg in New York. And that's where I learned to chart, was using the Bloomberg platform. And so the prospects of using a different platform at times in my career have been very, very challenging. But working with guys like Grayson and asking questions, watching how people like Grayson and you, Tom, and Greg Schnell and Arthur Hill, and watching how they actually use the conclusions they were able to draw using StockCharts is what drew me in. And what a lot of what you guys are hopefully doing today, watching people that are using things like StockCharts and seeing how they have things set up and mimicking that as much as you can in your own process is the way that I learned to use the platform a lot more effectively. And I think it allows you to make better decisions if you have a consistent routine.
Absolutely. And I'm looking forward to seeing yours because I'm taking notes as well.
I appreciate it, Tom. So what I was going to do, everyone, and listen, I appreciate Tom, you guys including me in this, and I'm hope I'm able to provide you guys all some ideas on how you can better think about the markets. And what I'm going to focus on is the evidence. When Tom asked me to think about what I would want to share with everyone, I sort of thought about this. I think one of the most common mistakes that I see investors make is what's called confirmation bias. And I'll show you one slide here in a little while that I think is the most important message I'm going to give you, which is the order of operations that you should be taking. My daughter is in middle school, and we are going through algebra and now into geometry and things like that. And we've been talking a lot about the order of operations. And it reminded me, as an investor, we often mess up the order of operations. And the problem is we decide what we're going to do first, and then we start looking at charts to try to help us feel better about that decision. And that is what confirmation bias basically is. You You decide what you're going to do, and then you try to make yourself feel better about that by looking at a bunch of things to try to validate what you've already decided to do. What we're going to talk about is how to flip that and to start with gathering evidence. And what's interesting is I think what Grayson showed you a little bit ago was a beautiful example of that. If you looked at that, looked at the order that he had set up with all of the crazy, pluses and stars and everything, was putting his chart list in a very meaningful order. And it started with, what is the market telling me? And then it went to, how am I positioned? And I think a lot of times we reverse that. We think about how we're positioned and then try to look at the market evidence and try to validate what we already are doing in our portfolio. So what I hope to do today is just share with you sort of my philosophy and how I think something like confirmation bias can get in the way. And then we'll spend time looking at my charts, and I'll share with you how I have my stock charts set up for a daily routine, what I call the morning coffee routine. This is the set of charts that I look at every morning. And again, I hope, if anything, it helps you think about where these challenges come up in your own process. And then with how you have things set up, think about your own morning coffee routine. How are you spending that crucial first chunk of the day when you're able to set yourself up for success, or unfortunately for a lot of us, set ourselves up for failure during the course of the trading day? So I've been doing charting in some way since around 2000. And, as I mentioned, I started my career at Bloomberg in New York. And so I was able to learn technical analysis from, working with a lot of really successful traders and investors. And at the time, I really didn't know what I was doing. I just knew I could ask a lot of questions, and spending time on, currency desks in New York and hedge funds up in Connecticut and, RAAs in Detroit, Michigan, just seeing how they were using charts was a really helpful part of my career. And I've looked back on those experiences often. In 2008, I went up and started running the technical research team at Fidelity. And I think that is what forced me to think less like a short-term investor, which is what I did on a lot of trading desks and a lot of hedge funds, and think more like a long-term investor. And probably that move was helpful professionally, but also for my own investing, because I was thinking way too short-term early on in my career. I was thinking like a trader, and I was trying to swing trade a lot. And, what I learned going to Fidelity is that there's a lot to be gained by looking at weekly charts and monthly charts and thinking about the secular shifts. And there is still very much a value to the tactical time frame. And I, talking with guys like Larry Williams about how you think about short-term dynamics, I think is really important. But focusing on your goals as an investor, I'm trying to think months, if not years down the road, which means that should inform the types of charts that I use and that I look at. I launched my own firm called Sierra Alpha Research in 2017, and then joined StockCharts and moved to the Pacific Northwest, where I'm at now, about two years ago, just over 2 years ago. And StockCharts has been a blast. It's a Chip Anderson, our founder, calls it a 23-year-old startup. It's still a very small operation in terms of the people, but it's so much fun, and working with guys like Grayson and getting to work with fellow contributors like you, Tom, and others that I've considered have become friends over years has been really, really positive for me, and I know for my family too. So here's my sort of general investment philosophy, and I'll give it to you in a couple slides, and then we'll get to a bunch of charts. I would describe the markets as being emotional. Early in my career, this was before quantitative investing was really a thing. And I remember going to a hedge fund, and I met this guy who was a mathematician. And I remember leaving the meeting going, why would an investment fund hire a math guy? And now it's laughable because most funds are dominated by math and physics PhDs and even at Fidelity, I mean, there's a whole department of quantitative strategists who are just trying to, create models to try to win this game on some different timeframes. So that's become much more widespread. But if you think about it, the markets are still very much emotional. All those guys are trying to do that are looking at the markets very mathematically. They're trying to quantify all the investors and what we are doing very emotionally with our investments, right? As much as we think we are rational, or that you may be taught in business school that you are rational, or you read something that says investors are rational and the markets are efficient, I can tell you from my own experience working with a lot of traders and being on trading floors and trading desks and investment shops, there's very little rational about most investment decisions. It tends to be a very irrational, very emotionally driven decision. And the challenge for all of us is just how well we manage that emotional input into our decision making. And I hope what we talk about today helps you think about that. It's funny when our portfolios do well, and the chart on the left is technology in 2019 into early 2020. When your portfolio looks like that, which is what the technology sector did in that period, where the price of your holdings are going up, the relative strength, looking at the XLK, the tech sector versus the S&P 500, when that's going higher, you feel like a rock star investment genius. And we tend to think and we tend to attribute our great performance due to our skill as an investor. I am such a good investor. Look at my awesome portfolio returns. When our portfolio looks more like the energy sector did on that same time frame, and the price is actually choppy to down and the relative strength is going down, we tend to attribute that not to our poor skill as an investor. We tend to attribute that to bad luck, right? The market just moved against me, just a string of bad returns, et cetera, et cetera. So when things are good, we attribute it to skill. When things are not as good, we tend to attribute it to luck. And what you have to remember, I would think, is that in reality, it's a mix of things. There's an aspect to successful investing that is based on skill. There's a great amount of it that is based on luck and just being in the right time and having the positioning in place. And I think there are ways you can address both of those. And I think I always remind my own customers, my own viewers and clients, that you have to focus on what is within your control and focus less on what is outside of your control. You can't control what the market's going to do tomorrow. You just can't. You can control certain things. You can control how you spend your time and what you do first thing every day, and what you watch and what you read and what you listen to and what you do with that information. Those are all things that you can actually improve on. So what I want to show you is just what I call evidence-based investing, which is getting to the things that you can control. And I would say there are two things that you need to focus on if you want to get better control over your investment decisions. The one is what happens inside your head. And then the second thing is what happens around you as an investor. Let's talk about each of those. Self-awareness is the ability, your own ability to have an honest conversation with yourself. And when I've worked with successful investors at Fidelity and elsewhere, the qualities of what I have found of very successful investors, they have very high self-awareness. They will tell you very quickly what they're good at and what they're not good at. They can tell you what makes them successful and what they have to fight against that would make them unsuccessful if they were left on their own. And what they do is they set themselves up for success. They put themselves in investment situations where they're going to benefit from their strengths, from their ability to identify good investments and stay with the right themes. But also they surround themselves with resources and systems and research and inputs that will help them minimize the impact of their weaknesses, right? So and again, I think what's good about for all of you watching places like StockCharts and EarningsBeats and elsewhere, I think you have more opportunity now than ever as an individual investor, as a financial advisor, to surround yourself with really effective inputs that are going to help keep you on the right place and just nudge you where you need to be nudged. And I would encourage you to think about what you need to do to make sure that you can address some of your potential weaknesses. The other thing I would say is the second item to focus on is what I call your situational awareness. And I've spent a good number of hours trying to learn how to fly airplanes, and I still have a great deal to learn. But this is what the panel in a Cessna 172R looks like. And what you are taught to do is, as you are flying around, wherever you're at, you need to have a good situational awareness, which is basically an awareness of what's happening inside the airplane and outside the airplane. So inside, you need to be able to glance at this panel and understand what the instruments are telling you. What are the conditions of the plane? How much fuel do you have? What altitude are you in? What are the conditions around you, et cetera? You also need to look outside and look, through the glass and see if there are any obstacles and things like that. And the reason why situational awareness is so important as a pilot is because over 90% of airplane accidents for private pilots are not due to mechanical issues. It's actually very rare that something happens with the plane and the plane goes down. Over 90% are due to human error. It's just bad decision making. And think about the parallels there between that and what could happen to you in your investment portfolio. And that's why I think situational awareness is so important. The number one reason, by the way, that airplanes go down, private pilots go down, is running out of fuel. And it's usually within a couple miles of your home airport. So literally the main reason why people have a very unfortunate end to their flights as an individual pilot is because the plane tells you it doesn't have enough fuel. You see that information, you think, well, I probably could get it just a little further to the home airport. And of course, the plane is not lying to you. It doesn't have enough fuel and that there's no wiggle room. The plane can't fly anymore. And unfortunately, when you lose fuel, when you run out of fuel and you're near the ground, it doesn't tend to end particularly well. So as a pilot, you spend a lot of time studying airplane disasters, airplane accidents, and you study real time when something happens to a private pilot. What was the decision chain that caused things to go poorly? And as investors, that's something I advise people to do often, right? Keep track of your decisions and spend some time going back and reviewing your own accidents as an investor, right? What happened? What were the series of decisions? What inputs did you pay too little attention to? Did you pay too much attention to? Did you not manage your risk effectively? But what caused you to be in the wrong place as an investor? And I think that is something that we don't like to do because it's tough to revisit painful events, painful decisions where we messed up in some way, but that is the way you're going to grow as an investor more often than not. That leads me to this page, which I previewed. I hinted earlier. There's one slide that is the most important, and this is the one. If there's something that you take and print out, screenshot this, and put it on the monitor next to where you make decisions, I hope this is the one. And this is what we should do versus what we actually do. I will tell you what an investor should do, which is gather a bunch of evidence, see what the evidence tells you, and then make your decision. Here's what I'm seeing around me. Here's what's working. Here's what isn't. I want to own what's working. I don't want to own what's not working. And I've made my decision. I gather evidence and I make my decision. As you can probably guess, we often don't do that. We reverse it, which seems kind of ridiculous, but I'll tell you how sneaky it is. We make a decision, which is we hear someone says Bitcoin's going to go to 200,000 or the S&P is going to go to new highs by the end of the year. You watch a talking head on CNBC saying gold is the next big thing or whatever it's going to be. We've basically in some small or large way made our decision. Then we start looking for evidence. We look at the chart of gold and we try to find what they were talking about, what convinced them that they were bullish. And all you're often doing is validating that bullish thesis or that bearish thesis, right? People are all jazzed about Bitcoin. So you start looking for things that will convince you that Bitcoin is positive. And what your brain is actually doing psychologically is it is looking at all the evidence, but stuff that validates your decision, it's attributing greater weight to that. And things that ignore, refute your decision or go against what you've already decided, you sort of mentally downgrade that or you push it away mentally. And all that happens is you end up surrounding yourselves with a bunch of reasons to do what you're already going to do. The problem is this is one of the main ways why we stay in bad trades or we get into bad trades in the first place, because we're making a decision without thinking of the evidence first. And again, I thought Grayson did a beautiful job of illustrating that in the order of his chart list. I think there's a reason why it starts with the big picture and then it goes to things like, what do I own? A lot of times, I mean, if your order of operations as an investor is looking at your portfolio or bringing up financial television and starting with what's happening there, I would say you're messing up. And I'll tell you why here when I get to my own morning coffee routine. So 3 things that I hope you keep in mind, and we'll spend the rest of the time looking at a bunch of charts here. I think the first one is you need to actively search for new narratives. And I will tell you, social media is fantastic. Grayson mentioned Twitter, and I'd encourage you to follow him. He does a great job of just sharing graciously things that he's looking at, stocks that he's looking at. I think it's fantastic. I'm on the Twitters as well at DKellerCMT, and I encourage you to follow my work there. But I publish a couple charts every day, just things that I'm seeing and things that I'm thinking about. And so Twitter and Facebook and LinkedIn, if you use those for investment purposes, all are very positive because they allow you to connect with other investors in a very meaningful way. And in my experience as an institutional investor at Fidelity, we had a great network of other institutional investors. I would pick up the phone and talk with other investors. I could go and talk to Peter Lynch or Bruce Johnstone and ask them questions about what they're thinking about inflation. And, Twitter allows you to do those sorts of things with some really successful investors. So I think there's a lot of upside to be had from those sorts of things. But here is the really dark underside that I think creates problems for investors. The problem with my own Twitter feed, when I bring up Twitter and I look at my own feed, is it's dominated by a bunch of people that think a lot like I do. It's people like Tom Bowley and Grayson Roze, who I think are very, very good. And I think they do exceptional work. And I love seeing what they're doing. But the problem is we are very much wired in a similar way because I tend to follow chart-oriented investors that are probably more growth-oriented than value-oriented and tend to like to buy strength versus weakness. And so as a result, if I'm looking to broaden my thinking and think about what an alternate scenario, what is the raging bear case for stocks, I'm probably not going to see that on my Twitter feed because I've carefully curated it to be people that think a lot like I do. I think that's the same issue that's causing a lot of political issues on Facebook and challenges on a lot of social media. Is you tend to, it's an echo chamber of people and ideas that are very similar to your own. So what I would encourage you to do is actively search for new narratives. The way you break out of that is by searching for things. Go on Twitter and search for, if you're bullish on Bitcoin, search for the keywords bearish Bitcoin and see what comes up and see what articles are referenced and read them and see what people are talking about that tells them Bitcoin is going to go down to 10,000 and see what is motivating that decision. It won't make it easy for you. You actually have to actively search for it, but I think it will be very helpful. And that's one of the discussions that I miss having at a place like Fidelity is we would have bull bear arguments all the time. All right, we're all bullish on Apple. Who's going to argue the bear case? Okay, go. And we would have the debate and you'd have to argue the alternate point of view. And it just made you stretch your thinking a little bit. And I think that's something that's missing for a lot of investors. And I think that this creeps up in a lot of places. The work from home trade, I think in mid to late 2020 is a good example of that. There's an ETF that was created in June of that year called WFH, the work from home ETF. And again, during that period when it was released, it seemed like a layup, right? This is a group of stocks that are going to be built on the fact that we're all working from home. It certainly seemed likely that that was going to happen, which it certainly has. I'm still primarily working from home here a year later. And so the idea that that was going to work, it seemed like an obvious win, but the ETF just didn't do very well in the first 3 or 4 months of, it kind of just was sort of this choppy sideways period. While a lot of stocks were actually outperforming just fine. So I think should is a horrible word to use. If you hear yourself describing an investment thesis or describing what you're thinking or how you're positioning, and you're using the word should as the main part of that sentence, you're messing up in some way. You are creating this narrative and you're talking about what should work. And I would focus on the charts, which tells you what are actually working. The second thing I would tell you is think in terms of probabilities instead of certainties. A lot of times we come up with our thesis. I'm bullish on stocks. I think the S&P is going to go to 5,000 by the end of the year, which I don't. So please don't take that soundbite and think that that is what I think. I'm giving you this kind of crazy, ultra bullish scenario that I don't think is probably going to play out, but it could. Who knows, right? So is it possible that the S&P could break above its previous highs at 45.50 and go a couple hundred points higher? Absolutely. Is it possible that the S&P could revert lower next week, blow below its previous lows, not just get below 42.50, but get below 4,000 to get all the way down to 3,700 and retest the March 2021 low? Yeah. Is that probable? I don't think so, but is it possible? Absolutely. Then there are a bunch of other scenarios. What if we sell off a little bit more and then rally and make new highs? What if we rally but never get above the September high? I think all of those are potential scenarios. But what we tend to do as investors is think of one particular path, position ourselves for that path, and then we're not really well equipped when something different happens, which it often does. I tend to think of things, and what a professional would do is think of it in terms of probabilities. Here's my most probable outcome. Here are the other scenarios. What would my portfolio do? What would my current holdings most likely do if scenario 4 happened and the S&P went down to 37.50 by the end of the year? What would my portfolio look like? How am I positioned for the S&P rallying straight up from here and going to 4,800 at year end? And then what are some other scenarios and what stocks would probably be leading and lagging? And I think by thinking through those probabilities and possibilities, you're opening yourself up for when something different, something unexpected happens. You've already thought through that scenario and you know how you may want to tweak your portfolio as a reason for that. The third one, this is what we'll spend the rest of the time here this morning, is to have a consistent process. Again, I thought Grayson did a great job, and Tom does a great job, on your show and with your own work of just having a series of lists which show, here's what I'm screening for, here's where I'm finding opportunities. And I think one of the great, their ability, Grayson and Tom and others, to make good decisions as investors are driven by the fact that they have a consistent way of gathering information and then making a decision as a result. And I would argue having a consistent process every morning is one of the most crucial things. This is what I call my morning coffee routine. It's a series of chart lists that I review every single morning, and it is in a very specific order for a very specific reason. And I mentioned earlier, if you start your process with either of these things, turning on your brokerage account or turning on financial media, I think that is a huge miss. And I will tell you why. When you log into a brokerage account, which I have some, of course, as I'm sure all of us do, when you log into your brokerage account, what does the screen do after you log in and you validate or whatever? What comes up? It's usually one of two things or both. It's what's happening right now in this market, minute to minute, second to second. What's the real-time data? It's also probably your portfolio. Here are the things you hold that are doing really well today. Here are the things that are doing pretty poorly today. It's all often based on short-term movements. And what I learned earlier in my career was never make long-term decisions based on short-term data. So if you were trying to look months or weeks or years down the road, and you're looking at flickering ticks today and making a decision based on that, you are completely misaligning your goals with the information that you're looking at. The same thing with a lot of financial media, with the obvious exception of StockCharts TV, which clearly gets this right. But I think a lot of financial media, I mean, the challenge with financial media and running, frequent, trading day information is getting caught up in the short-term fluctuations. Every little movement has to be blown up into a big important thing because they want to draw you in and watch more of their programming. And as a result, you get drawn into short-term stuff that probably isn't that important. A lot of times investing, I would argue, if you're doing it right, should be kind of boring. And it's funny, it's sad that the words trading and investing imply taking action. I was struck when I went up to Fidelity in Boston and started working there and working with some of the fund managers. I was thinking, all right, let's get into this every day. Let's make some trades. Let's make some position changes. And a lot of days, there would be a lot of work done. There would be a lot of thinking and reading and studying and analyzing and evaluating. But a lot of times a fund just wouldn't make a lot of trades, or if they would, it was just little stuff, little like tweaks on things, but it wasn't big changes. There are very rarely big movements because you learned about the balance between turning over your holdings and the potential gain, right? One way to consistently underperform is by churning your holdings and just whipping around with different themes. Like, it's just not the way that it's going to work. A lot of the performance you're going to get is by leaving things alone and just not touching things, letting things actually grow. So it's making good decisions at the beginning, but it's actually staying with things that are working. And so, again, I think, what you should do is start with the long-term trajectory. And I'll show you some of these charts with the rest of the time here. We'll look at them together. But I will tell you, I think these are the three things I try to do with any chart that I'm looking at. And this is what I would encourage you to do as well. I think as an investor, we should have three items we're looking at. Number one, identify trends. And that is the most important thing. My goal as a strategist, as an investor with my own portfolio, is to identify trends. I want to know what's working and what isn't. And most of my routines, my daily and weekly routines, are built on understanding the trends and focusing on what's working and what isn't. This is the chart of semiconductors, sort of mid-2020, midsummer. And this is when the SMH, which is a semiconductor ETF, is making new highs, breaking above 150, which was a nice break higher. It's above two upward sloping moving averages, which I like. The momentum is overall positive, but not overextended. That's good. The relative strength just consistently up and to the right. So if I ever have a portfolio that looks kind of like this, I'm probably going to feel pretty good about my positioning because this tells you I'm owning things that are working and don't mess with it. So step two, then, once I've identified trends, is to stick with those trends, follow the trends and follow the ones that are working, stay with things that are working. So that last chart ended about here in July. You can see for the next 6 months or so, everything kind of continued, right? It continued to go higher highs, higher lows. The relative strength continued to be strong. Overall, this is a chart that continues to work. So why mess with something that's continuing to add value to my portfolio, especially on a relative basis, the line at the bottom. So following those trends means sticking with what's working. It also means managing your risk and getting out of things that are not working. And that brings us to step three, anticipating when those trends are exhausted. A couple months later, you had a different look in early 2021. This is when the SMH was making new highs January into February. But you can see the relative strength is actually making a new swing low. You can see the price actually had just broken below the low from the previous month. You can see that the new high in February was met with lower momentum. So the chart's going higher, but the momentum is actually sloping downwards. That's actually a sign of internal weakness. So step three is looking for divergences, looking for short-term breakdowns, looking for indications that things are starting to change and starting to be less attractive. So what I want to do, this is actually basically those Chrome tabs, but opened all at once, so I can just quickly go through some of these and show you what I'm looking at and why. So literally every morning, this is the chart that I start with every day. And you may ask, why am I starting every day with a 5-year weekly chart of the S&P 500? I'll tell you why. If I am a long-term investor, which I am, and if I'm looking months down the road at least, which I'm trying to, then I better start myself thinking about long-term data. So instead of bringing up my portfolio and looking at today's trading, instead of bringing up my dashboard and looking at what's happening right at this moment with stocks and bonds and gold, I'm looking at the long-term trend in stocks, because my goal overall is to be on the right side of this trend and to understand what the conditions are as an equity investor. So I am looking at this 5-year weekly chart every day. Does it change much every day? Nope, it really doesn't. And that's on purpose, because every chart I look at after that has been primed from this long-term look. My starting point is as a long-term investor. And I actually have what I call a market trend model, which is a simple trend following model using weekly exponential moving averages. This just tells me the overall trend in the equity market. So I have the SPY. I have exponential moving averages here at the top using weekly data. My long-term model is simply the difference between the 21 and 34-week exponential moving averages. Is the shorter one above the longer one? If so, the long-term trend is positive. If it's below, the long-term trend is negative. As you can see by this purple histogram that for the most part has been above zero. Overall, this long-term model has been overwhelmingly bullish over the last 5 years, and even the 5 years before that as well, with some notable exceptions, late 2018, early 2020, when the market sold off enough to trigger a negative signal. But overall, we've been in a secular bull market, and I don't have a problem with the fact that the long-term trend reading is overwhelmingly positive. The medium-term trend model for me is the weekly PPO. So this is similar to the weekly MACD. It's a simple trend following tool using two other exponential moving averages. And this turned negative here in May when the two lines cross, or the short cross down through the longer term line. That's when it told me to start to get defensive. And you may think, wow, what a miss that the S&P has gone higher for the next 6 months after that signal turned negative. I would disagree, because I would say for many investors, May, June through September, October has been a disastrous period, depending on what your portfolio looks like. And I think this has been really helpful for me to think more defensively. Again, I'm never going to not stick. I'm always going to stick with trends that are working. And so the fact that the market kept making new highs tells me overall I'm going to stay with that as long as I need. But this definitely helped me think more defensively, particularly with stocks that were down 10, 20+%, even as the S&P and the NASDAQ were making new highs, particularly stocks in some of the cyclical sectors, right? Some of the energy stocks, financials, industrials, things that really have rotated lower and have lost a lot of ground even before the S&P and the NASDAQ started to sell off. The short-term model is simply looking at where we're at relative to the 5-week exponential moving average. And to be honest, my daily chart of the S&P is where I usually think about the short-term trend, but this is just a great quick version of that. And it just reminds me, what is the short-term impulse of the market? And this week, this Friday, it turned back positive after being negative for the last 4 or 5 weeks before that. The daily chart of the S&P is the second thing that I look at every day. And I spend a good amount of time with these first two charts, just thinking about them and what that means for me as an investor. For me, I talked back in July, August about the series of things I would need to see to turn from bullish to bearish on stocks. And it had 4 pieces. Number 1, break below the 50-day moving average. Number 2, make a new swing low. Number 3, make it a lower high. And number 4, have the RSI break below 40, which would get it out of this bullish range. It had spent the entire year of 2021 above the 40 level, which told you it was overall in sort of a bullish phase. All 4 of those things happened by mid-September, right? We had broken below the 50-day moving average, closed below it, and stayed there for the first time all year, since last September and October, really. We had made a lower high there in late September. We had made a lower low undercut there. We had also had the RSI go below 40. All 4 of those things were checked off. I then started to think about what would I need to see to turn less bearish. And my base case has been pulling back to around 40.50, which would be about a 38.2% retracement of the September last year low to the September 2021 high. That would get us back just below the 200-day moving average and take us back down to the May low. It'd be about a 10%, 12% pullback from the all-time highs. And that seemed like a healthy move. What I saw last week has told me that that may not actually come to pass. And the things that I would look for to turn more bullish are a couple things. Number 1, put in a higher low. Number 2, put in a higher high. Number 3, get back above the 50-day moving average. Number 4, the RSI above 60. We've done a couple of those things, arguably, with Friday's rally. Thursday, we closed above the 50-day. We followed through there on Friday, and we got above the swing high from late September. So on the tactical time frame, I'm certainly seeing a market that's starting to rotate back more positive. The one thing we've not done is the RSI getting above 60. And again, what Connie Brown taught me years ago, reading her book on technical indicators, is the whole range of a momentum indicator should fluctuate, depending on whether we're in a bullish or bearish trend. And that's been a really helpful tool for me understanding the price dynamics. So at this point, I'm sort of neutral, leaning a little bit more bearish again, more bullish again, given the strength that we saw on Friday. I'd want to see if that continues this week and further validates that with the momentum conditions improving. With the time we have remaining, I'm going to go lightning speed through some of these other chart lists. And again, the goal here isn't to give you an exhaustive market overview, but just show you how I think about it. And I would, again, encourage you to think about your own process. What is your morning coffee routine? I'm not going to tell you that mine is perfect. It's certainly good for me and what I'm trying to do, what questions I'm trying to answer. I would encourage you to think about what questions you are trying to answer as an investor. What are your goals? And then make sure you set up a morning routine that's going to help you answer those questions effectively. So where I go next is a little deeper view in the US equity market. This is where I look at large caps versus small caps, look at the value line arithmetic index, which is testing a new all-time high. So where I look at Dow theory, looking at things like the Dow Industrials and the transports, the Dow, the S&P and the NASDAQ, and compare all of those things. And I think the main conclusions I would illustrate here, and this is the candle glance view. I actually look at most of these in a candle glance view and I actually drill in and out. I know Grayson was looking at the chart book view, which is a really cool way to do it too. I really don't do that very often. I actually use the candle glances because I like looking at all of it together and have a nice one-year chart for each of these just to start with. And then I'll drill in and out as I need to. Look at your experience as an investor owning the S&P 500 in the last year. Look at your experience as an investor owning the NASDAQ 100 over the last year. Look at the very painful experience you would have had over that same time period owning small cap stocks. The Russell 2000 has been flat since February of this year, while the S&P and the NASDAQ made new all-time highs every month until this last one. The Russell 2000 small cap stocks have been flat. And I think that lack of participation in small and mid caps has been a key theme why a lot of investors have struggled. And I think a reemergence of strength in small caps would be one of the things that I think would validate the theme of the thesis of renewed strength in stocks between now and year end. The next thing I look at are global ETFs. So for me, it's thinking about the regions, the US versus non-US developed, non-US emerging, and then frontier markets, which is arguably a pretty narrow thing. The idea of frontier markets, I think, is fantastic. This is looking at things that are, not emerged enough to be considered an emerging market. This would be things like Vietnam and Saudi Arabia and Kuwait and, some more developing stock markets. And if you think decades down the road, it would seem to me developing Asia, developing Africa, these could be really good opportunities for long-term growth, and they're considered frontier markets. The problem with a lot of those, they're not super liquid yet. So if you have an ETF like FM, you're not getting enough exposure to some of those things that, and again, as those markets develop and they're able to be included in something like FM, it's worth noting that index has actually been beautifully successful and much more successful than something like emerging markets. It's sort of like the emerging markets is how to think about it. But it's interesting when you look at this view, you can see that there are a lot of similarities, but this view, as I've watched it over the, every morning, is where you've seen the rotation lower in China. And, I was asked a couple months ago, does these challenges with China, sort of the real estate debacle and the news coming out of it, how is that going to impact the US market? And what I told the interviewer was, listen, the Chinese markets peaked in February and they've been in a pretty consistent downtrend since then. The S&P 500 has not appeared to be affected too much by that yet. Now, that could change, but the chart's going to tell me when we're being affected by it. We haven't. This has also reminded me that that markets like India have been incredibly resilient, while other global markets have been struggling, and the dollar has actually made it not super profitable to own non-US markets. Then I will do what's called an intermarket analysis and look at all these different relationships. This is where I focus a lot on things like Bitcoin, which I think has a lot of upside. If it can eclipse its previous highs around 64,000 and get to new highs, I think there's a lot more upside that could be had. This is where you've seen the strength in crude oil and recognize the resilience in the energy space. This is where I think one of the most important themes, which is the rise in rates, I think is most important. And I think a rising rate environment is one thing that very few of us, unless you've been investing before 1980, have really experienced in a market where the rates have been increasing over time fairly consistently. We've not seen that in a long, long time. I've never seen that as an investor, and many have said, and any younger investor has absolutely not experienced a rising rate environment. The key there is that's when financial stocks actually start to improve. We're not seeing that yet. And so I think that, we could be in a situation where things like financials actually do really well. Then what I do is I go through three really important groups: breadth, sentiment, and ratios. This is where I think about market breadth, the overall conditions, where I think about sentiment, things like survey data. This is where I look at ratios, things like the consumer ratio that I saw Grayson share earlier, which is actually making new highs this week, which I think is a really important, not very bearish and quite bullish tell, is the fact that if you look at the ratio of equal weighted consumer discretionary versus staples, it's going up, not down. I then look at the RRG, which is Julius de Kempener's really well-designed visual, which shows you how the S&P sectors are rotating around the benchmark. This is probably the most helpful tool in my toolkit this year, recognizing the leadership shifts. I don't think it's been necessarily about following the S&P higher, even though that's worked for the most part this year. I think the story this year has been about leadership rotation. It's been when the FANG stocks are dominating, when things like tech and communication services are doing very well. It's recognizing the strength in the cyclical sectors like financials and energy, making a new high. If you stop the clock in May of this year, the banks were probably some of the better charts that you see. Banks and real estate were probably the best places you could be besides energy. Then all of that changes. And then in the middle of the year, you have this renewed strength from things like technology. And so looking at the RRG and recognizing those rotations has been so super strong. And what I'm seeing now is a resurgence in things like financials, in energy, and consumer discretionary. And those are some of the best opportunities I see between now and year end. I then very quickly go through sectors. I go through industry groups. I go through a lot more industry groups. And then I look through the Dow 30, which seems like a really antiquated thing to do. And it probably is. I met Louise Yamada decades ago when I was with Bloomberg, and she very graciously used to come up and visit us in Boston when I was at Fidelity. And I will never forget, we're looking at all these charts. We're whipping through thousands of charts a day. And when she wanted to make sense of the markets, I'm not kidding, she put down on our table, our conference room table, she unwrapped these hand-drawn point and figure charts that she had been maintaining, and Alan Shaw had been maintaining before her for like 40 years. And she still was using these same charts that had just these like taped together papers kind of tracking it. I was like, oh my gosh, she's just looking at the Dow, and look at how much she's able to draw just looking at these 30 names. And it's again, is it a broad representation of the market? No, but I'm already looking at a lot of things already. It just forces you to think about what stocks are working and what stocks are not. It helps you see that Home Depot is making a new all-time high while most of these Dow 30 stocks are not. The only ones that are making a new high this week are Salesforce.com, CRM, it's Home Depot, and that's pretty much it. Those are the only two names. Maybe United Health made a new high this week, but it's very, very few. And so recognizing those changes, recognizing what's working and what's not is really helpful. At the end, what I do at the end of this process, and I don't have them up in front of me, would be things like my brokerage account, looking at the dashboard here, which shows you what's happening today. And again, I think it's unfortunate if you start, even though StockCharts is an amazing platform and I would highly recommend it, if you start at your dashboard, which is focused on short-term data, I think you're missing it. If you look at how Grayson has his chart list set up and the morning coffee routine that I've articulated for you, it is based more on long-term to short-term. It's big picture to it's macro to micro. It's the weight of the evidence, and then looking at some of the individual ideas in your portfolio. And then after all of this is when I would look at my own holdings. So that we're about out of time here for, but this is what I wanted to describe with you. I think the biggest challenge you face most likely as an investor from a behavioral perspective is focusing on your thesis first, and then your evidence second. It's unfortunately reviewing making your decision first, and then gathering evidence to try to make sense of it. And I would encourage you, that slide of flipping it is the most important thing I can share with you. Focus on the evidence. And I think that's built on your ability to gather good evidence is based on your ability to have a good weekly routine, which I think Grayson provided very well, and a morning coffee routine, which is what I share with you here. Think about how you spend those crucial times at the beginning of the day, because how you prime yourself then is going to inform your decisions through the rest of the time. I'm welcome to take questions here in a second, but just a couple ideas if you want more of what I'm putting out every day and every week. My YouTube channel is called Market Misbehavior. I actually just posted a video a couple days ago that choose your own adventure style S&P 500 look. Though that chart where I showed you the 4 scenarios, you can watch. I'll talk through each 4 of them, and you actually vote in the comments section of which you think is most likely and why. It's really helpful to sort of think through that and look at what some people are responding and see how you would vote relative to what they are doing. But check me out there if you like. As Tom very nicely mentioned, my own show is called The Final Bar. I host the Closing Bell show on StockCharts TV every weekday, 4 p.m. Eastern. It's a lot of fun. We have a lot of really good guests like Tom and others that share their expertise. It's really, really fun to talk about the markets every day like that. And then finally, if you can read the tickers on this last StockCharts candle glance page, you can get my last message, which is thank you. Really appreciate it, Tom, for inviting me, and Aaron, who did a lot of the coordination, does a really good job for you guys. But I appreciate it. Really, am, as always, impressed by you and what you do to analyze the markets, and appreciate you incorporating both Grayson and I into the day here.
Yeah, excellent presentation. I think I'm saying that on behalf of everybody who's here today. I mean, it was really good. You and Grayson both did great jobs. The purpose here was to try to, use or, have a couple of experts who are, really familiar with all the workings of stock charts and be able to go through a routine and a process that works, to be very organized, and to have this process that you can rely on, week after week, month after month, year after year, and so forth. And I think both of you did that very, very well. And I really appreciate you taking your time out on a Saturday to come out and hang out with us today. Also, I want to say on the final bar, one part that you do on your show that I really like is your mailbag area, because that gives the audience a chance to kind of interact, and have some questions that, they may be watching what you're doing, or maybe some other things on stock charts. And it gives you a couple of minutes, really to sit down and go through some of the questions that your viewers have. I think that's a great, from a educational perspective, I think that's always great to have that kind of interaction. But great shows. There are some questions. So one question that came up, and there are some specific kind of questions, and you can do what you want with them. But I'm going to first, just kind of as a broad question, what type of exit strategy do you use? I mean, you obviously have a very organized way of looking at your charts and so forth, but is there one particular thing that if you're holding a stock and it's a longer term position, what's the one thing that maybe keeps you up at night, or that bothers you about a stock? Is it a 50-day failure? Is it a 200-day failure? Is it relative weakness? I mean, what is it for you?
Yeah. No, it's a really good question. And I would say that whoever asked that question, I think the fact that you asked that question is really, there's a lot of wisdom in the fact that you're asking that question, because I think too often we think way too much about our buy discipline and not nearly enough on our sell discipline, right? I think, for me, the successful investors I work with, and famously at Fidelity, Peter Lynch used to say, you're going to be right 4 or 5 times out of 10 at best. So don't expect to be right 10 times out of 10. And the other thing we would always say around our shop was it's okay to be wrong. It's not okay to stay wrong. And one of the worst mistakes you could make was be wrong on a call and then just dig in your heels and be more and more wrong as the market went against you. And so I think having a good exit strategy is arguably more important. And if you just make a bunch of random choices, but just manage your capital well and get out of things that aren't working and staying with what is, in a lot of cases, you're actually going to do pretty well as an investor, because you're going to get out of things that aren't working. The chart of Disney, I think, is a good example recently. There are a number of things that I would say. I think, for me, especially given the strength that we've seen in the markets overall, for a lot of stocks, they were consistently above their 50-day moving average. And so I think, particularly this year in 2021, if you wanted to know where to be and what to scale into and what to scale out of, scaling out of things that were breaking their 50-day moving average is really important. even now, given the strength in stocks, it was still, at least as of Thursday, I think there were only 50% of S&P stocks above their 50-day, which means half of the S&P members, 250 of those stocks or so, were still below their 50-day moving average before Friday, which told you that even though the market was kind of recovering, a lot of individual names had not. And recognizing when that came down, back in April, it was like 92%, I think, of the S&P above their 50-day. So over the course of, April, May, June, July, a bunch of names were breaking down, but a bunch of them were not. And recognizing which stocks were not working and which were was so important. And I think that hits on what you suggested, Tom, which is the relative strength. If there's one thing that I think individual investors don't use enough for risk management, it's this relative line. And it's very simply, all you need to do is look at a ratio of the stock or the ETF you're looking at versus the S&P. This is the line that will keep you out of things like the ARK Innovation Fund, which again, regardless of what you think about the long-term prospects of things like AI and robotics and all the payment processing and all the things that Kathy Wood is going to get you exposure to with something like ARK, if the relative strength line is going down, it just tells you the market is not rewarding that theme right now. Right now it's rewarding things like steel companies, and as our friend Greg Schnell will tell you anytime you ask him, copper and energy, like that's what's working right now. So it's not those names, and so the relative strength line gets you out of things that aren't performing as well as other things. So with Disney, particularly in March, this is when I felt very encouraged by Disney and all of a sudden turned very negative on the stock, particularly on a relative basis, because we're breaking the 50-day. The momentum is going below 40. The relative strength line is going down. And somewhere along that journey, you have to decide that it's no longer a great place to be. And while you haven't lost a lot of money owning Disney, it's the opportunity cost. It's where you don't have that capital, where it's parked in something that's just not doing anything. You've missed out on some of those names that have been doing so well at the same time. So I would say relative strength for me is probably one of the more important ways to manage risk.
Yeah, I would absolutely agree with you there. How about the flip side? I mean, you have a list of stocks that you're stalking, that you're waiting for something. There was a question about, is there a stock that, something would trigger you to want to buy that stock? Is it something similar to Disney where it's going sideways and you're waiting for that breakout to the upside?
Yeah, so I am super. It's funny. There are some people that I use the scanning engine on StockCharts all the time, and there are some people that use scans, to make very particular. They're looking for a very particular set of circumstances. I actually do really simple scans because I just want a list of charts, a group of charts that I can work with. And again, it goes back to Fidelity days where we killed a lot of trees with how many charts we used to print out, but we actually had printers in all of our offices, which seems like a pretty antiquated thing. Probably now, I'm sure they don't anymore, but you would print out hundreds and hundreds of charts a day, and you would just put them in piles, and you just think about, all right, what's breaking out, what's breaking down, what's sideways, and then you'd start sifting through those charts a little more. So for me, screens are good. The main scan that I run a couple times a week are stocks making new 3-month highs and stocks making new 3-month lows. And early in my career, I used to look for 52-week highs and lows, which still isn't a bad thing. But the problem is things really, in some ways, have to appreciate quite a bit before they can make a 52-week high. And you saw that, like in 2020, right? A lot of stocks had come off so far from their January or February 2020 highs. It took them quite a while. It was a lot of ground to make up before they get on a 52-week high list. But if you look at 3-month highs, you'd find things that were recovering off of those lows in March, and we're really starting to break out. And in June, particularly, that's when you start to see things really start to improve. That's where things like Disney made new highs. So, for me, I mean, a stock that just came up on my screen this week that I think is a decent one is Home Depot. And I would tell you, as much as buying weakness, I think makes sense, for me, it's about recognizing the trends. And something like this, which has been in, what we call a basing pattern, something that had a nice run, which Home Depot did in April and May out of the March low there, and then stabilized. And for the last 4 or 5 months, it's really gone nowhere on an absolute basis. It's been sideways. As a result, it's underperformed quite a bit. Now, all of a sudden, it's breaking. It's what I'd call a change of character. Something is telling you that the buying power is outweighing the selling pressure. There's more buying interest than there is selling interest at this point. and it's able to propel the stock to a new place. So instead of us all agreeing that Home Depot is worth around 330 a share, we've now decided that it's worth a lot more than that. So something has motivated buyers in a new way, and I love looking for breakouts like that show for potential for further upside. I mean, another maybe example of that was something like tech. This is in the materials sector. This is maybe a shout out to Greg Schnell. We did our special, Tom, you and I and Grayson, Chart Madness Revisited, and Greg wouldn't stop talking about copper names. This is actually a copper name based in Vancouver. So this is a huge shout out to Greg Schnell. But tech is a material stock. It's a little smaller cap, 15 billion US. But again, a similar kind of pattern, sort of had this nice consolidation pattern, what you call a cup and handle pattern, and breaking to new heights. I like stocks that have been unable to break out that are now able to do that, because I think there's something there. And if you manage your risk effectively, those can be some really good trends to participate in.
Excellent. One other thing I would add to that too, because I've struggled with 52-week highs because a lot of the stocks are very stretched. And so many times you're looking at them, they're very overbought. So one thing I'll do sometimes is look at like a 52-week high or a 3-month high or 6-month high or whatever, but maybe look for scooters that are below 80 or RSI below 65. So it's a stock that, you're not seeing go up and up and up and up every single day. Rather, it's a stock maybe that's been consolidating for a while, like the ones you've shown. I mean, that Home Depot and tech, those are much better stocks in my view because they've gone through a basing period.
Yeah, that's right. And if you look at my chart list, I have way too many chart lists because I tend to create them. But if you look, these are all the scans that I run for new swing highs, and I save them so I can go back a couple months ago and see how did these highs do later. But one of the things, so this is the list that I just ran, and when you bring up the summary tab, you can sort the whole list based on the scooter ranking and look at some of the weaker trends that are starting to break out. That's how something like IHG actually came on my list, because it was, it does not have necessarily, it's not super extended like some of the names have been, but it's just more of an emerging breakout, which is what I like the most.
Yeah, absolutely. One last question, because we need to wrap up. And this is maybe a tough question to answer quickly, but how important is emotion and position size for risk management when trading? Your opinion.
Ooh, that could be an hour-long webcast.
I knew I shouldn't have asked.
I'll give you the short version, and then I promise I'm doing a webcast for my own firm called Market Misbehavior. I'm doing one on Tuesday talking about some charts that you should watch between now and year end. So you're welcome to check that out at marketmisbehavior.com if you'd like. But I will do another one. Maybe next month we'll be answering that question in more detail. But my short answer would be two things. I think, what you're suggesting, which is using emotions to weight your holdings. That's what we would call conviction weighting. And it's a little bit dangerous, because what happens when you're weighting them based on conviction is if you are highly convicted about very volatile, if you're highly convicted about Bitcoin, your entire portfolio is going to be based on the movements in Bitcoin. It doesn't matter what else you have because it's so volatile. So I would encourage you to think more about either, leaning into more about equal weighting, right? No position should be bigger than 2% or something, which just limits your exposure, at a starting point at least. Or think about what's called like a volatility weighting. Make sure that you have larger positions in things that, are not going to ruin you, especially with something like, cryptocurrencies are a perfect example of that. Small cap names, really choppy names, because what happens is your entire portfolio's performance will be driven by one or two things. And if you're really trying to diversify across a bunch of ideas, you need to position yourself and weight your bets as a result of that. But that is my short-term answer. I will try to do a longer-term answer later this year for sure.
All right. Awesome. You know what I did forget today? Both you and Grayson, I kind of let you off the hook because I was going to have you give 5 stocks. So I'm going to ask you to do this in your giveaways, your chart lists. Could you put your 5 stocks, just 5 ideas? Obviously, we're not recommending to anyone to go out and buy these. These are just maybe 5 stocks or ideas that you're considering or that you're looking at. Maybe you annotate them, maybe you don't, whatever. But could you put together maybe a chart list for everybody of a handful of stocks that you're watching for whatever reason?
I would be happy to do it. And I have subtly and not so subtly mentioned a couple of them through the course of the presentation. Okay, for fine. Example, things like IHG that I mentioned, that's one that just came up that I think is a decent one, but I will absolutely do that. So what I'm going to share with you guys, and again, I'm so thankful that you're doing the event and that I was a part of it. I'm actually going to include the chart pack, all the charts, most of the charts that I showed you today will be part of that. that giveaway. Also, what I call the Mindful Investor Live chart list. This is a chart list that I update every day and keep it updated. So if you go to it, you can see some of the big picture themes that I'm following. And I'll also include these 5 names that you asked for. I'll put them all together for you guys.
Excellent. Really appreciate you coming to join us today, Dave. Thank you so much. You and Grayson were awesome. And just on behalf of everybody here, thanks for participating with us on a Saturday.
You got it. Have a great day, Tom. Thanks again for setting it up, and stay safe, you guys.
All right. Awesome. All right. We're going to take a quick break. We were going to start back at about 1:05 Eastern, but let's just give it a couple minutes. I'll come back at about 1:07 or so. And then we'll get the last segment started. Got a couple surprises for you. So hang in there. We'll be right back. Hello and welcome back, everybody. Appreciate you taking time out on your Saturday to join us here at ChartFest 2021. Again, I want to thank our 2 guests, great presenters, Grayson Roze, David Keller, both from StockCharts. Really appreciate them spending some time with us on a Saturday, taking time out of their schedule to hopefully give you some great ideas. I mean, that's really the whole thing. Not everybody, I don't work the way Dave does or Grayson does. They don't work the way I do. Everybody's different. You're going to have your own approach, but I think it's the organization and just having the process and maybe giving you some ideas for how you can use the powerful platform that is StockCharts to make better decisions, make more informed decisions. That's really what ChartFest 2021 is all about. Of course, we're going to be going through a lot of charts, and I'm going to have a ton of charts with you or for you. At the end, we are going to have what I'm calling a lightning round. So after my presentation, if you have any individual stocks that you'd like for me to take a look at, I'd prefer if everybody just asks one and we'll see how many I can get through. If you're putting a handful of them, it's going to be very, very difficult. I can tell you that Erin's going to be silently getting me these stocks, and I'm going to ask her only to pick one. So if you put multiple stocks down, I'm just not going to have time. I'm not going to have time to get one from everybody, but I will try to go through as many as I can in rapid fire session, fashion, just to give you a sense of how I would look at the chart very quickly. So we'll do that at the end. Probably it'll take place in about an hour or so. Again, for those of you that are still here and have been here the whole time, I know it's a long session, but hopefully you're enjoying it. We do have a recording for all of the sessions today. You'll get copies of that. We're going to have some free gifts for you in terms of chart lists that you can view or download. I will again ask you, if you haven't already, StockCharts has a free 30-day trial. No commitment. You can go in for 30 days and check it out. And if for no other reason, drop these chart lists that we're all giving you, put them in your account and just start working with it for 3 or 4 weeks and just see if it's making a difference. I believe it will. But they have a free 30-day trial. We do as well at EarningsBeats. So love to have you give our service a shot. I can tell you that before the end of your 30-day trial, we will reach out to you. We don't just automatically charge you after 30 days. If you don't want our service, honestly, I don't want to take your money. If you don't like what we're doing and you don't think the value is there, that's not really a member that's going to be happy with us longer term. So we just want you to try our service. And if you like it, hang around. We'd love to have you. Okay, so what I'm going to do today, I'm going to show you how I combine the StockCharts and EarningsBeats platforms. And, when I was at StockCharts, if you don't know it or not aware, I was a senior technical analyst at StockCharts for about 4.5 years. I started with them in March 2015, worked through, I guess it was August or September of 2019 before coming back to EarningsBeats, which is where I was when I went to StockCharts. I left and went over to StockCharts for a while. It was a great platform. I really wanted to do a lot of educating. So I was able to write my Trading Places blog every morning. I did shows, loved what I did at StockCharts. And I love what I'm doing now with EarningsBeats. I still have that great connection with StockCharts. I still write, I still do my shows, and I'm able to put together a platform here at EarningsBeats that combines things that I'm passionate about. The earnings, strong earnings, making sure that I'm always trading companies that have reported strong earnings. We have a short squeeze chart list. I'm going to go through all of this with you and show you our platform and how we combine it with StockCharts. But I think it's powerful. I think the StockCharts platform is powerful. I think our platform is powerful. And I think the combination is just explosive. So we're going to go through all of that. Let's go ahead and pull up the agenda, go through and just talk a little bit about a few things I'm going to go through here over the next hour or so. So we've got this research platform that we've established. I just want to walk you through it. I'll try to go through very quickly to give you a sense of what we do. And then I'll show you from a top-down approach how we look for leading stocks in leading industry groups. I'll show you the process, how I look at the market, and then how I go through the various sectors and industry groups down to the stocks to try to come up with leading stocks and leading industry groups. Then we'll go through the scanning routines. These are all pretty basic scans. I really liked what Dave had to say. He said his scans were pretty simple. I tend to do the same thing. I mean, we don't have anything crazy in our scans. I probably couldn't write one that's that crazy. To be honest, I don't understand the writing of the scans that well that I could write it. I didn't develop the scan engine, so I tend to have very simple scans, and it works for me. But we'll go through some of the scans that we look at. I'll also show you how you can scan against multiple chart lists, which is so cool. If I've got a researched chart list that I know are all strong earnings, and then I've also got a chart list with companies that have raised guidance, I can then run a scan against the two to see which companies have done both. I think that's a pretty cool feature. And how about if I have another chart list of companies that have strong AD lines, and I run a scan of all three? That's what I call my bullish trifecta chart list. So there's a lot of things that we're going to go through there. And then, as I said, lightning round. If this presentation I'm going through takes an hour, what we'll do is we'll take a couple-minute break, and then we'll come back, and I will specifically try to get through as many stocks as I can. I'm not going to stay here all afternoon, but I'll try to at least give you a good solid 25, 30, 35 minutes of stock review. So if you have individual stock questions, just type in the stock symbol as we go, and I will try to get to those at the end of the presentation. So I am going to go out now and start this and just give you an idea of what it is that we do at EarningsBeats. All right, so let me start. And I'll just go to our member portal, our member homepage, and show you how things appear and give you a little sense of, again, what it is that we do. All right, so the first thing that you're going to see when you go into our member portal, if we have any announcements like today for ChartFest, we make sure our members are aware. We do a lot of events, so this is how you're going to see it. And we're going to let you know too through our daily market report. I'm going to tell you when we have an event, that sort of thing. So there's going to be plenty of ways to make sure you're aware of it. And then also we record everything. So even if you can't make it to one of our events, we're going to get the recording to you. Now, I kind of break things down, and I look at our service really as guidance, research, and education. Those are the three staples at EarningsBeats. The guidance comes in a lot of different forms. Probably what I would say, if we have a flagship product at EarningsBeats, I think it's our daily market report. It's a report I write every day that goes out to members, usually in the afternoon, sometimes a little bit earlier, but I try to get it out most of the time by about 3 o'clock in the afternoon, Eastern time, before the market closes. Occasionally it'll go a little bit later. And the reason for it is I think some of the most important part of the trading takes place after lunch. Mornings, a lot of times, if I wrote the report in the morning, by the time the afternoon came around, everything would be completely different. And so I think the morning time, you want to be a little careful about making too many trading decisions unless it's going in your favor. So if you want to buy a stock that's in a pullback, I think sometimes in the morning gives you a great opportunity. Take advantage. But if you're looking to go long a stock and it's up in the morning, I tend to hesitate. So anyway, that's why the daily market report tends to come out in the afternoon. Now, the way it looks, I'll just go through again very briefly. But here was the announcement that I made on Friday about ChartFest. Make sure members knew. We have chart lists that we constantly update and make available for our members. So I usually will put in here if any chart lists have been updated, so members are aware. They can go into the website and they can download them right into their account. Then I'll go through the quick, 60-second executive market summary of what's happening today. So if you don't have time to look, but you just want to kind of get a feel for maybe not just the top line or the market's going up or down, but maybe a few of the stories. This is where I try to bring that into play. Then I'll go through and I have one chart and usually a paragraph or two about the market outlook, something about the market outlook that I think is important. We saw, I think it was Grayson earlier today talking about consumer discretionary breaking out. There it is, the XLY, talking about what a big breakout we were getting in consumer discretionary. And also there's your relative strength that Grayson also was talking about earlier. So that's in a chart, goes out to members. Sector industry focus. Normally I'll find some part of the market that I find fascinating or that I'm looking for something to happen. Here's your retail sales. So I pulled up the XRT because retail sales came out on Friday. Talked about some of the keys with retail sales and the fact that when consumer discretionary outperforms, generally it's retail stocks that are moving higher. And retail stocks are a big part of consumer discretionary. So right now, we've got consumer discretionary breaking out, but retail hasn't yet started to move. So watch for a potential breakout there. These are the kinds of things that we talk about. Then the chart list and the strategy. So I try to find a stock or two, maybe 5, that for whatever reason are looking interesting to me. They may be trading candidates for our members. They may not. I try to also talk about, if I think it's a really volatile stock, I try to pass that along, because I don't know what all of our members' risk tolerance levels are. I don't know the types of stocks they like to buy, small cap, large cap, dividend, value oriented, or growth oriented. I don't know any of that. So for me to just have a service that says, here, buy these, I think personally it's irresponsible because I don't know what all of our members are able to do or wanting to do, or, there are some who might be on fixed income that can't afford to lose much capital. And you might have others that have gambler's mentality. Give me the meme stocks. What's the big mover in the short list, short squeeze list. Everybody's different. So I try to keep that in mind and try and talk a little bit about these stocks, why I like them. And then you can, decide if that's the case for you or not. So here were a couple of those. Then I'll go through and show you earnings reports today and the next day, just so you know what's coming up. And then key earnings reports, not every earnings report. And then I'll just quickly summarize the economic reports that were out for that day. So that's, in a nutshell, very quickly, goes out to our members every day. You've got trading ideas, you've got market guidance, you've got a quick executive bullet, maybe 8, 9 bullets. But I think a great feature of our service. Then you've got portfolio report that comes out every week. So we have 4 different portfolios. When you go through here, it'll show you all the rules and objectives of what we're doing with our portfolios. But the thing is, we're going to summarize it every week, how our portfolios are doing versus the key benchmark S&P 500. We'll go through and talk a little bit about the weekly summary here, showing energy was leading, real estate lagging, that sort of thing. Then we'll go through each of the portfolios and just give you a summary of how the portfolios are doing relative to the S&P 500 since their inception. We update this every week for our members. And then how the model portfolio component stocks performed last week. So you look at them, and normally I look for the ones that are struggling, because those are the ones likely that members likely have the most questions about. So I normally won't be saying, hey, giving everybody high fives, the one that did well, but normally I'm going to go to the bottom and see if there's anything that's really bothering me. And so for Crocs last week, when it broke back down, failed to get through the moving averages and turned back and set new lows at the end of last week, I pointed out that this gap support zone is an area where we could see Crocs move down to. Now, if you're more of a long-term investor, you might look at this and say, it's fine. As long as it holds that level, I'm hanging in there. A trader might look at this and say, if it gets down to this level, I want to buy. Everybody's different. And I don't know how everyone's using our portfolios. These are portfolios that change every 90 days. We look for leading stocks, 10 leading stocks in 10 industry groups, and we equal weight them at the beginning of the quarter, hold them for 90 days, and then we rinse and repeat. So we're constantly rotating our portfolios every 90 days, and the performance has been pretty spectacular. But you look at Crocs, though, and this is what was pointed out a week ago. Let me show you the chart. So here is, let's go to the daily chart. So on the daily chart, here was that support zone, 120 to 125 that I put out there in the portfolio report. And then the very next day, it was actually Monday, went down to 125. It bounced $12 from there through Friday's close, 10% move off of the top of that key support area. So as a trader, it's also providing opportunities in that area. It's not just for those who are wanting to just buy and hold, but I try to give information. So if somebody wants to put a stop in play, that's completely up to them. We don't use stops. We hold these stocks for 90 days and then just move on. Anyhow, that's you can see this report going through all of our different portfolios, stocks in each portfolio, usually trying to recap one. Here we actually have a new portfolio that we're kind of testing right now. It's an earnings reaction portfolio. You can see it's trailing the S&P 500, but it's fairly new. We just started this. Here are the stocks that are in this one. And then we get into a summary, what happened during the week. And then finally, we have a model ETF portfolio, which I mentioned at the very opening of ChartFest 2021. These model ETF components, these 6 ETFs that we're currently in, we will be swapping them out on Tuesday. That is draft day for our model ETF portfolio. So that is our, this is really our flagship, products, the daily market report, the weekly portfolio report. Then we have a seasonality report that we go into. We give you the 20 stocks that I gave in September at the beginning of October. We look at them, see how they did. How did they do on average versus the 2 major indices? And then normally I take a look at one, like the best performer in September was Live Nation Entertainment, which had gone up, broken out at the beginning of October. And then you can kind of see, is it something that you want to trade? Here was the breakout. It's continuing to trend higher. Just like Dave Keller talked about, you look for trends. Look at this sideways basing pattern for months. Then we get the breakout, increasing volume. This stock looks to me like it is now trending higher. So this would be a stock I'd be very interested in owning. All right, so then I'll come out and I'll talk about a look ahead at the October. We talk about how the month of October tends to break out since 1950 on the S&P 500, giving you percentages. annualized percentages during certain periods of the month. Talk about sector performance, what tends to do well in October, what tends to do poorly, industry performance, and so forth and so on. Bring up some charts. Here was the banking group talking about possible patterns that may be setting up for banks. And this gets back a little bit to what Dave was talking about. What are the different scenarios? What are the possibilities? What are you looking for? What could happen? That's what I think when you're looking ahead, trying to identify patterns. Those are some of the things I believe come into play. Then I'll go through all the other groups and talk about some of the industry groups within the sectors and so forth. And then I have stocks for October. So I'll give you 20 stocks at the beginning of October that historically have shown very strong seasonal tendencies in the month of October. And I put all 20 stocks in a chart list annotated for download to our members. So that's just another report that goes out. Again, part of the guidance that we give. How about a short squeeze report? You know, when GameStop took off earlier in 2021, everybody seemed to all of a sudden begin getting into these short squeeze stocks and a lot of the meme stocks. I actually published in our EarningsBeats Digest newsletter in September of 2020, 6 months before GameStop took off. I said, GameStop could be the mother of all short squeezes. And so we now take a look at short squeeze candidates every month. Beginning of every month, we will talk about short squeezes, talk about stocks that are hot. So these are ones that could really run, and take a look back at some of them, of what happened that we called the prior month. Really some interesting information if short squeeze is your thing. Also, the short squeeze chart list that we do is downloadable for our members. And you can see here just a snippet, but we have them ranked. Every stock that has a short percentage of float over 20%, and we rank them. So you can see this is number 5005 because it's at 29%. CRTX is right at 20%. That was the 38th stock. And I think at that point we had 38 stocks on that list. But we number them in order of the short percentage of float. So when I talk about our guidance, research, and education platform, these are some of the things we do. Now, our primary research is going to be our chart lists. That's where we organize all of our thoughts, whether it's the short squeeze chart list, whether it's seasonality, whether it's strong earnings. You go down this list, we have instructions on how you can download these into your account, how to download. We have a video instruction. Try to make it as simple as possible for our members. And then we go through all of our chart lists. We let you know when we've recently updated. I also tell you in the daily market report. And then all you do is you just grab this password, copy it, hit the StockCharts link. It'll come up with a space for you to put the password in. You do that, and then you simply download right into your StockCharts account. Couldn't be any simpler. Right now, 567 companies are on this list. Companies that we've already vetted for you. We've gone in, looked at their earnings beat Wall Street consensus. Their revenues beat Wall Street consensus. They also are liquid. We make sure that the stock is a liquid stock. We don't want to be trading stocks that are illiquid. And then we also look technically at the charts. So some companies that report great results, we don't include if we don't like the technicals. So we're marrying good or great fundamentals with great technicals to come up with this list of stocks. We have relative strength industry group chart list. When I talk about the top-down approach in just a little bit, this is where I'm going to go. I'm going to show you how we work our way through the relative strength of sectors and industry groups. But then you go right down the list. We have this earnings AD chart list, which is fairly new. This is just looking at stocks that look like they're being accumulated heavily after their earnings reports come out. Again, a separate chart list. We put them together. You can take a look at them in your account. Short squeeze chart list, strong future earnings chart list. So these are companies that look really good technically, but they're not on our strong earnings chart list. So if we look at the great technical charts that are out there, we basically strip out those that are already on our strong earnings. And so we just assume that, hey, if they're trading strongly and they're not on our strong earnings chart list, that probably means Wall Street's expecting future earnings to be strong. So that's why we have that. You can see there 289 companies on there. just updated this week. Raised guidance chart list also just updated this week. Any companies raising their guidance that are liquid essentially go on this chart list. 560 companies on there right now, and we're constantly updating all of this. There's our portfolio chart list. Model portfolio, aggressive income, strong AD or strong accumulation distribution. These 4 portfolios, if we go over here, I'll show you. We also keep, this is our homepage at EarningsBeats. So if you just come in and you're not signed in, this is what you're going to see. But you can scroll down and you can see our historical performance. So these 4 portfolios that I'm showing you, here's our since inception performance. The model 209% right now through Friday's close versus 66% on the S&P. Aggressive 112 versus 56. Strong AD 70 versus 53. Income is the only one trailing, 42 versus 56. But the income dividends have not been included in here. So this is just a performance of the stock price, has nothing, does not include the dividends in here. So all in all, I think our performance has been pretty good. Then we also break it down by our current quarter, which 2 of them are doing extremely well and 2 of them are lagging just a bit, but overall doing pretty well. And then also we have our ETF portfolio performance here as well. All right, then we go through all of our webinars. Oh my gosh, we have so many chart lists. I counted them up today. Right now we have 21 chart lists that our members potentially could download from our website. So pretty intensive research. So that I just wanted to go through and just give you a sense of what it is that we have that we offer our members and the work that we do. So I want to move on now, and I want to talk about the top-down approach. So the first thing I do, kind of like Grayson was laying out, Dave was laying out, you start off just looking at the overall market. I mean, if you got a top-down approach, you're looking at the top. You're not going to start looking for stocks. You're going to look, how do you feel about the market? And so not just do I want to look at, you know, what the S&P 500 has been doing this year, or even for the last few years. I've got a chart that looks at it over the last 100 years. I think that's a pretty good sample size of, you know, the long-term picture on the S&P 500. But the point I want to make here is that you've got periods of secular bull markets and periods of secular bear markets, secular meaning long-term. So these periods right here that are in the red shaded areas, these are what I would refer to, and most I think would agree, these are secular bear markets. You go nowhere for a long time. When you finally break out, it's a signal. It's not just a signal that, hey, we broke out. It's a signal, in my opinion, that you've got money that's making major rotational shift from one asset class to another. So now all of a sudden, US stocks are in favor when we start getting these double top breakouts. We saw it in the 1950s and we went up, we trended higher for 20 years. Now, we had 4 or 5 recessions in here. We had, I think, 3 cyclical bear markets where we lost 20%. But the big picture is that we were still going higher. It's kind of like, you know, with the ocean, you got the tide that's going a certain way. You can get in a boat and you can go against the tide. You can go up for a period of time while the tide's coming in, but you're not going to go very fast if you go against the tide. If you go with it, you're going to go a lot faster. That's kind of the way I look at the market. When we get into these secular bull markets, you're going to go a lot faster if you're on the long side than if you're trying to catch each one of these moves to the downside. Yes, they happen occasionally, but trying to always catch the bearish side is the losing side as far as I'm concerned. I would rather be on the long side and have to deal with the occasional movement to the downside. Secular bear markets are different. You get major drops and the rallies never take you back to new highs. And you don't really know where these rallies are going to begin. But then you break out of that period. And once again, you move for 20 years to the upside as you have another one of those huge secular shifts in the market. And all of a sudden, US stocks are in favor. Right in the middle of this 20-year secular bull market, we saw the market crash in 1987. Look at that little blip. And I said earlier in 2021 that I believed the pandemic, or earlier in 2020, I should say, I believed the pandemic was going to look like 1987. That I believed we were in a secular bull market. I wrote about it. I think it was in Chart Watchers on March 13th, right in the midst of everything collapsing. And I said, we're in a secular bull market. That was my belief. And a lot of it comes from looking at this big picture and just seeing what I expected. Now, there's no guarantees, but I think it gets back to one of Dave Keller's points, which I think is really important. You've got to plan, you've got to look at all your charts, and then try to see how the near term, the short term is fitting within your longer term themes. Because if you try to make decisions always based on what's happening today, you're going to get whipsawed. You're going to be, getting out, and then the market goes back up, you're getting back in, and you're never going to have a consistent plan. So I look at the market, and I am a firm believer we are in the midst of a multi-decade secular bull market. I don't think this is ending for the next 10 to 12 years. When it does, look out below, because I think we'll have another one of these red shaded areas when money rotates away from US equities and goes elsewhere. And no matter what you think about the charts or how much you try to get the market to go higher, it's not going to go higher. It's going to struggle. We'll get there. I don't think we're there yet. I think the movement to the markets to the upside. And so when I take my top-down approach, my very first thought process is we're going higher. I don't know if we're going higher next week or next month, but overall, I believe we're going higher. And so my trading strategy is going to be developed based on that. If you look here also, since April 10th, 2013, and this is as of a couple weeks ago, so it's not through this Friday's close, but this breakout occurred. This double top breakout occurred on April 10th, 2013. A lot of folks say, well, this bull market started back in 2009. I don't agree with that. How do you know? You don't know until you break out. I mean, 1975 or 74 had been great to say, hey, I don't remember anybody holding up a sign saying that the bear market ended. You don't know it until you break out, until you start seeing money rotate back into that area. So I think the breakout occurred in 2013. I think we have 20 years from there, or roughly. I mean, could it be 16? Could it be 22? Yeah, I don't know that there's anything magical about 20 years, but history tells us it's going to be an extended period of time. And I don't think it's been long enough. But here are all the sectors and how they performed since April 10th. And what you see are all of the aggressive groups tend to do or have done much better than your defensive groups and energy and materials. To me, energy and materials are the wild cards, because I don't think it has anything to do with aggressive or defensive. I think it has to do with other issues, geopolitical issues, the dollar, which direction is the dollar going in? There are different things that impact materials and energy. But I think the other groups, I think you're going to see aggressive stocks outperform and defensive groups underperform in a secular bull market. So as I start to develop my plan, where do you think I want to invest on the long side? I'm going to be looking almost entirely at technology, communication services, discretionary stocks, financials, and industrials. That's 5 of the top 6 performers. And you can throw in healthcare for good measure. There are parts of healthcare that are aggressive as well, like biotechs and maybe even medical equipment. But anyhow, those are the areas that I'm going to be looking for to outperform the S&P 500. Good luck in these other defensive areas, finding stocks that are going to outperform the S&P 500. Yeah, it could happen. Now, I think what we need to be paying attention to, and I think Dave touched on this a little bit earlier, financials. When you start getting yields moving, financials become a pretty important part of the market, and financials can do very well. I don't think rates are going to go flying to the upside, but any kind of movement to the upside, and I would expect financials to start climbing this list. I think financials will be an outperformer. Will they outperform technology, consumer discretionary? I don't know, but I do think financials in a rate rising environment, I think you want to make sure you have exposure there. Industrial, same thing. And these are groups that didn't do very well, especially since the pandemic. So we're starting to see more of their leadership though recently. So that's something to keep in mind. All right, so now we've looked at the market. I'm bullish. Where do I go from there? Well, I'm going to go to the relative strength of sectors. And I already know from that, what I just showed you, the aggressive groups are the groups that have really done well since 2013. But I just want to kind of glance. Here's technology relative to the S&P, definitely trending higher. Consumer discretionary, I think, was in a bullish wedge, relative bullish wedge, or bullish relative wedge, however you want to call it. Anyway, lower highs there, lower lows, but they're squeezing, and they went back and tested this relative breakout. I think discretionary is just getting going to the upside. So I like this group a lot here in the fourth quarter. Communication services going the other way. Long term looks great, but you don't lead the S&P all the time. You take breaks. I think communication services is taking a break. Look at a stock like Google. All right. So if I pull up Google, look at this chart. I mean, it's gone from 1,100 to 2,800 in a year and 6 months. Now, maybe it goes higher, but at some point it's probably pricing in I don't know if it can keep going up like this. And I'll bring up another chart. Let's look at Amazon, because Amazon basically did the same thing. 1,800 to 3,400 in 4 months. Yeah, it was great. But you know what? If you got in at the end of that, look what happened. I love Amazon. Amazon's a great company. I think it could be a staple in any portfolio. But the reason it's going sideways is because it made such a huge run. Look at what it did in 2017, 2018, or even 2015 all the way through 2018. Huge upside. 5-6 bagger. So what did it do for the next 18 months? It went sideways and consolidated. Made a breakout, going sideways. Great long-term holding. Short-term, it's been frustrating. If you're trying to trade Amazon right now, good luck. We had a false breakout, went down, had a false breakout, false breakdown. Now we're in the middle. Amazon, I've tried to trade it. I've actually not done very well trading Amazon. So, these are the types of things you have to be thinking about. So is Google a great place to be right now? I say, I think it's probably stretched, very stretched. So I would be tempted to move my money away from Google. Now, maybe it goes up for another year. Maybe we get to 4,200 before it, it's hard to say, but I would at least be maybe reducing a position I had in Google because of the huge run. All right. So I go through all the sectors. I do that. And then I go through the industry groups. So let's say, like right now, I'm a big fan of consumer discretionary. So in this chart list, and by the way, this is a chart list that's available to our members. Our relative strength sectors and our relative strength industry groups can be downloaded by members. The only thing that we ask, because this was a long time putting this together, and once it's in your account, it's in your account. The only thing we ask is that you're an annual member. We give it to you as a gift as an annual member. You have it in your StockCharts account forever, even if you don't renew with us later on. But we put this out there for our annual members, and you can literally look at every industry group relative to the S&P 500. So I'm going to go down here. I've got all my technology industry groups with 001 and then numbered over here, 001 through 08. So just kind of using the numbering system at StockCharts to be able to rank these charts, keep them in order. And then I go into consumer discretionary. So let's just go through consumer discretionary. This is showing you relative strength. Down here on the bottom, you can see hotels made a breakout. When we broke out on an absolute basis, look at what happened to relative strength. All of a sudden, money started rotating into hotels. This is a strong group right now. Then you get toys. Well, toys, on the other hand, the market's been going up, and look on an absolute basis. Toys were 1,550. Now we're at 1,200. Why are they going down? You know what? I don't care. That is the worst question to ask a technical analyst. Why? We don't care why. It's going down. And I have people argue with me all the time. Well, the stock market can't go up because debt's too high, or, people aren't, going back to work fast enough. And we've got so many issues in the market. And I look at the market, I don't care. Look at all the issues that we've overcome in the stock market the last 10 years. I heard so many excuses why the stock market can't go higher, and we're still hearing them. And it's just one after another. And it's like Dave talked about the confirmation bias. If you're naturally bearish, you have plenty to choose from in media. I mean, there's a story for you every 15 minutes about why the market can't go higher. I don't look at it. I look at my charts. That's all I look at. But here you got toys going down. So do I want to be in toys? No, it's not working. Stay away from it. Then you got restaurants. Okay, so here are your restaurants. Now, restaurants on a relative basis down near a 3-year low. You're going to find pockets of restaurants, some of them that are doing well. Chipotle comes to mind. That's been a great performer in this group, but you're going to have to find that individual star. You know, it's kind of like if you're a baseball fan, I'm a Baltimore Oriole fan. Trust me, it's been painful for many, many years, but it's like finding an all-star on the Orioles. The Orioles aren't going to make the playoffs. They're not a team I would bet on, but they have individual players that are really good players. And that's kind of the way I would look at this. If I'm going to go into a restaurant stock, it better be a superstar like Chipotle. Otherwise, I have no interest. And this again, is you're top down. You're looking from the market being bullish to the areas being bullish to the sectors, to the industry groups within those sectors, and then down to the stocks. So I'm trying to find the areas that I would be interested in right now. Specialized consumer services on a relative basis, no thank you, not working. Clothing and accessories, not working. Home improvements. Well, you had Dave talking about Home Depot. Look at this group moving up, strengthening. PPO, relative PPO strengthening. The group just broke out. Home Depot just broke out. Leading stock and a leading group. That's how you zero in on individual stocks. Recreational services, no thank you. I mean, we can go through this list. I know these by heart. It's almost like Grayson was talking about earlier. You go through these charts frequently and you can see them in your dreams or in your nightmares, I guess. So depending on your approach. But let me see. Specialty retail has been a pretty good group. And I just told you about retailers. Look at specialty retailers starting to pick up. Look at the breakout that they made in August right here. See that double top? They broke out. When they broke out, look what happened to relative strength. So look for the absolute breakouts, but then you should be looking for that relative strength to follow. Once you get a breakout, more money is going to start moving into the group. Travel and tourism has definitely been strengthening, but still overall long-term, not great. It's starting to roll back over. So we want to be a little careful there. Again, I'd only look at superstars. Let's see what other areas. How about footwear? Footwear, pulled back quite a bit, but now it's starting to turn back up again. It had broken out right here above about 2,600. And if you notice on an absolute basis, we went back down and almost to that breakout level. And now we're starting to turn back up again. So you're combining price support resistance, which is technical analysis 101. We get down to support and we start to turn back up again. And now we see the relative strength starting to build in this group again. So relative strength in footwear suggests that maybe we could look at this group. How about business training and employment agencies? Look at this. This has been trending higher now for about, 16, 18 months, something like that. You probably haven't heard this on CNBC. Where's this on their show? I haven't heard any. Well, of course, I don't listen, so maybe they have been talking about it. But business training and employment agencies, one of the best areas of the market. This is the relative chart. Look at the absolute chart. We were down at 80 and we're now at 230. Huge move. Now, at some point, we're going to probably run out of steam. We're going to see that relative strength roll over, and then it'll be time to move elsewhere. But right now, the group's on fire. Autos. I really love the autos. And I talk about Tesla a lot. I can't even believe I've been talking here for 45 minutes already and haven't mentioned a single thing about Tesla. But here's your auto group turning back up on a relative basis. And look what just happened. We just broke out on an absolute basis. So Tesla is starting to fly toward its earnings, which come out next week. You got to be paying attention to the autos. All right, so that is basically it for the top-down approach. So scanning routines is pretty easy and pretty quick. I don't have to spend a whole lot of time here, but essentially what you want to do, or what we do for our members, is we have scanning strategies on our website. And if you click here, you can find 5 very quick little scans, and you can just copy the syntax and take it over and drag it into StockCharts. So for instance, if I want to do high volume, actually, I'll do one that's even better. Let me see if I can find which one would be a good one right now. I'll do that 52-week high. So let's do this, and I'll add another filter to it. So let's just copy that, and let's go over here. You go to your dashboard and come down to scans. And I'm going to do a new scan. I already have the syntax I want, so I don't have to worry about any of that right now. I'm just going to go ahead and post that in there. I mean, I could leave the volume scan in there, but what I'm going to do is go ahead and maybe, yeah, I'll just leave it at that, the 52-week high. And then I can put a filter in here to give me, let's use a technical indicator. And Dave and I were talking about this a little bit earlier. So this, if you were listening in, then maybe this will make sense. But you go down to the RSI, grab the RSI, and add that. It'll come up. The default is greater than 70, but what we actually want is less than, because we don't want a stock that's been going up and up and up and is very overbought. So maybe what we do is, are there any breakouts where the RSI is under 60? So it's not even close to overbought yet. In order to have an RSI under 60 and be setting a 52-week high, there's a pretty good chance that it's been consolidating for a while. So that's the whole idea here. So let's just run this scan. I haven't run it. I have no idea what's going to come up. 51 stocks. There are also going to be some other things on here as well. I didn't sort. I probably could have sorted a little bit better. I could have left the type on there as a stock. That definitely would have gotten rid of some of this. But let's just sort it in scooter order. And we'll just pull up one that's down here somewhere that's got some volume. Hershey's. Okay, here's Hershey's. Now it's only a 54, 2.6 million. It's in a defensive area of the market, so it's probably not going to be one I'm going to look at and trade. But it did just set a. I mean, I'm seeing a cup here. It looks to me like we got up, barely broke out, and now reversing candle. I think we could get a handle here, maybe back down to the moving averages. So if you wanted to trade something that doesn't present a lot of risk, Hershey's might be a great candidate for you. I don't know what their dividend is. I guess we could, well, I'll run out of time here, but it's, you know, if you're somebody who's more interested in dividends and maybe slow movers, Hershey's might be perfect. If you're that gambler mentality type of trader, then you're probably going to look at Hershey's and say, really, why are you bringing this up, Tom? And again, I don't know who's who out there. So I'm just pointing out different strategies for different folks. But if I do this, let me try and find one other one that's a little bit in one of the aggressive areas. Well, let's look at Boot Barn, because remember, the RSI is under 60. So even though the scooter's high, this actually is a pretty good one to take a look at, 350,000. So let's pull up Boot Barn and see what this looks like. So it's setting a 52-week high, but it's not one that's been going straight up. It's actually been consolidating now for about 4 weeks. It really isn't much higher than it was a few months ago on a relative basis, you know, versus the S&P 500. And I use a relative chart. You can see the stock relative to the S&P 500 just been, you know, went sideways for a little while, now just breaking out. It's a very strong stock among the apparel retail group, but apparel retail is horrible. So this is one of those superstars on the Baltimore Orioles. That's the analogy here. You got Boot Barn, which has been a great performer in its space, a great performer versus the S&P, but it's in a space that's horrible. So what happens if this group actually were to bounce? Chances are Boot Barn would do pretty well. I mean, it's going up and outperforming, even though money is coming out of its group and going elsewhere in the market. That's a good sign for the stock. So anyway, that's how I would use, you know, some of our scans to come over and find some stocks. We also could take our scans and let me pull up. I'll do one other one real quick. And this is what I do almost every day in our daily market report. When I do chart list strategies and I show you those individual stocks I pass along, I'll run usually some sort of a scan. So let me take this one, which is our downtrend reversal scan, which I happen to like. I like to buy stocks that have been downtrending and are starting to show a turn back to the upside. So if I take that and go back over to the scan workbench, I'm just going to get rid of everything here and paste. And then the beauty is, once you've downloaded our chart list into your account, you can go into your chart list. And let's just say I want to run it against the strong earnings chart list. I can just add the strong earnings chart list. Now I'm going to have this scan that runs. I should be looking for any reversals that come up in the strong earnings chart list. There may be none. You got to go down 5 days in a row and then just starting to turn back up again. That's the only way you can get on this. I'm going to run it and just see if we have any. Three out of 500. So all of a sudden now I could look at, you know, maybe this one that's got a 99 scooter. Take a look and just see if it's something I'd be interested in. Well, it was downtrending 5 days in a row, and it did put in a higher high, but it closed weak. So I'm not sure I'm overly excited about that one. So I'd go back and maybe look at Align Technology. Well, kind of the same thing. Finished weak on Friday, and it's in a downtrend. I think I'd need to see more on that one. And whoops, let me go back over here. And the last one is Darden Restaurants. Now, this one is more interesting to me. It did finish weak, but we're above the 50 and we're right at gap support. Look at that gap up with heavy volume. So this one, to me, instead of chasing a stock on a gap up into the 160s, now I've been patient and I'm actually getting it back at gap support at 149 in the 50-day moving average. Now, I didn't have to go and look at 5,000 charts at StockCharts to find this stock. This is a stock on our strong earnings chart list. They beat Wall Street estimates, top and bottom line, and the stock just went through a period of trading down at least 5 days in a row, and it showed a higher high on Friday. And when I pull it up, it's testing gap support. I think that's pretty good stock to maybe be thinking about. Now, it's in the restaurant group. So is it a leader in restaurants? Well, I pull up my relative chart and I go down here. Well, we were close to a 52-week high, just a 52-week relative high just a couple weeks ago. So yeah, this one's a pretty good stock within the restaurant group. So this one, along with Chipotle and maybe a couple others, are stocks that I would consider in restaurants. But because of this, the relative weakness in restaurants, if the gap support didn't hold, I would exit quickly. This is how I would manage risk. If it's not in a good group, I'm not making any excuses for it. It needs to turn at this gap support. Or if you're playing the 50-day, that's fine. Whatever, whatever you like to play. All right. That is essentially what I wanted to go over. I wanted to just show you all how, I developed my own trading system. I mean, basically, this is what I was doing before we started EarningsBeats. So before I came back to EarningsBeats and we kind of revamped all of our services, I started using a lot of this. And the portfolios that we do is educational in my view. Some of our members trade them. Our members can do with it whatever they want. We are not registered investment advisors. We say it all the time. We are not recommending anybody to buy or sell any stocks. What we are doing is educating. We are trying to put together portfolios to just show you that if you stick with leading stocks and leading industry groups over time, you have a good chance to beat the S&P 500. And I'm going to bring up those results again because 80% of mutual funds over the last year have lost, well, I think it's over a 10-year period that study was performed, but 80% of mutual funds cannot outperform the S&P 500, 80%. And part of it is because, number one, they're over-diversified. Over-diversified, you might think diversification is a great thing, but if you over-diversify, you almost have no chance of beating the S&P 500. Why? Because as we've all pointed out today, you get to the S&P 500, which is cap-weighted. If you don't have those large cap stocks in your portfolio and weighted at least as much as the S&P 500, good luck. You're not going to outperform. And we actually saw that at EarningsBeats a couple of quarters ago. That was one of the things. We were very heavily into the growth stocks, but we didn't have some of the big names. We didn't own Apple. We didn't own Microsoft. I don't remember if we had Tesla at that point or not, or whatever. But those stocks, some of those stocks went up while other growth stocks got crushed. And that's when ARK funds, was hit and so forth. But anyway, I could go on and on. But the whole point of our platform and what we try to do in marrying with StockCharts is to put together our research and their powerful chart list and all the tools and features, the scan engine. We put it all together for our members to hopefully make this process easier for our members to make money. I mean, I guess if you come in and it doesn't work for you, then you're not going to stay with us. And I wouldn't blame you. But hopefully as you're with us and you see our process, you'll understand, why we've developed what we've developed here over the years. But working at StockCharts for 4.5 years was so cool for me because I got to experience, it's like Grayson was saying, you have a passion for doing something and then they pay you for it. And, to go to work and to do something that you love to do. And I love doing this. I love doing these events. I love educating. And even if you don't agree with what I'm saying or some of the conclusions that I come up with, that's fine. It's, again, goes back to what Dave said. You want to get as much information as you can and just see what makes sense and what doesn't. Take the bullish side, take the bearish side, and figure out how to put your plan together and then expect the unexpected. All right, I'm going to go ahead and take, I know we're running a little bit late. I always like to run a little bit late. But Aaron, if we have some individual questions maybe that folks have, and then I'm going to come back in a couple minutes and go through a lot of charts with you. What, do you have anything?
Yeah, we do have a couple of individual questions. So the first one, piggybacking off of the portfolios, is what is the typical percentage of your largest holding? And what is the typical or targeted average percentage of each portfolio holding?
Well, when we start, I mean, we put 10 stocks in each portfolio, and at the start of the quarter, they're all equal weighted 10%. So by the end of the quarter, obviously one might be 20% of the portfolio, another one might be 6% or 7% or 12% or whatever. So the percentage of the holdings is not, or is going to change as the prices change throughout the quarter. Our philosophy and what we found by using this is that generally out of 10 stocks, you're going to probably have 2 or 3 that are going to carry the portfolio. You've got leading stocks, many stocks breaking to new 52-week highs and so forth. Wall Street loves these companies. And you know what? If Wall Street loves them, I love them. If Wall Street doesn't love them, I'm not going to buy them and hold them until Wall Street starts to love them again. Think back to how long energy was an underperformer. Yeah, energy's been doing great for the last year. Anybody that's been trading or buying and holding energy for the last 10 years, ask them how that has gone, because that has not gone well. So our philosophy is really, where's the strength? I mean, that's what all of us have been talking about today. I agree with Dave. I think relative strength is the most important thing in the market. And I see CNBC, and I even see Jim Cramer sometimes talking more about charts and relative strength. And I just chuckle because I think he's finally getting it. He's a brilliant man, by the way. I'm not going to question his intelligence. Jim Cramer is awesome. But a lot of times he would go in and he would argue fundamental points. And I would look at a chart and I'd be like, there is no way I would ever own this stock, at least until it, it's got to start to turn around. But he's now shifted. He does a lot more technical stuff. But anyway, hopefully that answered the question.
Okay, the next question. In your opinion, how much weight do you give chart patterns versus relative strength?
I like both, but they're different animals. One might confirm the other. The one thing I'll say about these continuation patterns, and I'm going to pull up something like, let me think of a chart. I think PayPal is a good example right now. So PayPal, and I'm going to pull this up on a relative chart, and I'm going to go down. I want to stretch it out for more than, let's go out 3 years, just so we can kind of get a little bit bigger picture. So if you look at PayPal, do you see how relative to its group, it was so strong? It was a leader in the computer services space. And that was right when it set this high. Now I'm going to annotate this for you because I think that PayPal is incredibly bullish. I love this chart. So right here, we have what I consider to be a longer term ascending triangle, and it's just starting to turn back up through the moving averages. So you can see right here, we just went through the 20-day, which is at 265. PayPal's 268. So it's just started to look better on a daily chart, but it's more of this long-term move up, sideways consolidation, which is extremely frustrating. You're watching the S&P 500 go up all year and you own PayPal and you're going nowhere. You're like, oh my gosh, this is such a loser stock. I'm going to get out of it. By the time you get out of it, which would maybe have been last week when it was struggling again, I think that would be the wrong time to get out of a stock like PayPal. But look at what this does. Look at what the sideways consolidation, the continuation pattern, look what it does to relative strength. The group has continued going higher, but PayPal, which had crushed the group for a long time, is now basing. When you base, you're going to lose relative strength. So when I see a pattern like this, it just depends on the kind of trader you are. You are like a long-term buy and holder. I would be absolutely holding PayPal. No chance I'd be letting go of the stock. If we went back and lost about 220 or so, then I would, longer term, that would be a problem for me. But right now, I love PayPal on a long-term basis. Short term, you see the top hit, you go back down, you start looking at, triple bottom here. I would begin to think especially after a huge run that stock's got to consolidate for a period of time. So as a trader, I might start to lose a little bit of interest in a stock like PayPal as a short-term trader, because again, going back to what Dave said, you have opportunity costs. If you're holding a stock during consolidation and the stock market's going up, you're losing on a relative basis. That money could be invested elsewhere. So short-term, I'd use these patterns as I recognize them to exit and move my money elsewhere until I feel better, until I hit a key support level or until I break out of the pattern. But it's how I use them together. I still view relative strength as the most important, but I'm going to give it an excuse because you're in a continuation pattern. Hopefully that helps.
So we have an attendee who's asking if you could expand a bit more on zeroing in on stocks based on their Scooter score. And he's particularly interested in Scooter scores under 80. But if you could quickly show that, how you do that within this scanning tool, I think that would be helpful.
All right. Well, like I said, we run scans and then we can drop them into ChartLists if we want. So what I'm going to do is I'm going to start with the ChartList. I mean, you can run the scan and then just add the filter. You know, if you're running a scan, whatever it is, add a filter for Scooter, less than 80. And I'll show you how you can do that real quickly. So let me just select a scan that I have already set up here. I don't know what I have. Well, I mean, we could do, yeah, let's just do 52-week highs. That's easy. So 52-week highs, there's the default that comes up. But what you can do is just add another filter and go down here and pull up Scooter, add. And instead of Scooter greater than 90, which is the default, you might say, oh, that was actually 80 that he was looking for. So let's go Scooter's less than 80. And then you run your scan. And so now I would personally, oh, what did I do here?
You entered in a 7 type equals stock.
All right, I was on the wrong line. There we go. Sorry about that. Let's try this again. Yeah, the scan engine doesn't like typos. Yeah, there's 2,000 of them. I mean, but, you know, only because we have the volume, which is crazy. It's going to try and it's not going to let me do anything here. Let's go back to that for just a second. And how about we go with 4 million? That'll take out a few. And we'll do it over a 50-day period. Let's run this scan. All right, now we have 453, which is at least a little bit better. So if I now go through here, see how the Scooters are all below 80? So now I could, you know, go through here. Now I could put other filters in to get rid of a lot of this other stuff. You got these trusts, you got ETFs, you got foreign stocks, you got all kinds of stuff in here that I would want to weed out. But that was just to show you how you can add the Scooter. Now, the other thing that I would do is let's just bring up a chart here. If I go into one of my chart lists, like the strong earnings chart list, and I go to view all, and I put this in summary form, and I've got Scooter on here, I can look at the last, you know, what happened yesterday at all the stocks that are on this chart list and see which ones went up. I can also quickly see which ones went down. But the other thing I could do is I could bring up the Scooter and show you in Scooter order. So you can see the top Scooters, how they did. And if you wanted to look at only the ones that were under 80, you just scroll down, you know, and on this chart list, you go down here and you say, okay, here are the ones under 80. And then the other thing you could do is add, you could scan for it, but you also could manually just add sector and industry group. I don't know why my screen is freezing here. All right. Anyway, if you go in and then you can find that on your list as well. I don't know why it was freezing up on me, but I don't want to waste time with that. So maybe one more question. We'll take a 2-minute break and then I'll get in the lightning round.
Okay. In your article yesterday, you talk about accumulation scans. Could you share one?
Oh, you would ask that question. I think it is in my on my other computer, in my other account. Let me think about this. Well, first, let me just go back and see if it's in this account. This StockCharts account, I have 2 StockCharts accounts, and this one I use for my shows. So I really don't use this computer for a whole lot. And I use this particular StockCharts account for my shows. And I have another account that I use for my regular trading. And when I'm writing the daily market report, I've just got them set up differently. But here, let me see if I put it in here. Now I'm going to look, hold on, I'm on my other computer now, which obviously you can't see, but I'm going to see. I'm pretty sure I have it on the other one. I mean, what I'll do is maybe I'll just type in the first part of it for you. And then you would just have to kind of copy and paste or whatever. Yep. My strengthening AD is on my other computer. So let me edit. All right. So let me give you a new scan. And so essentially what this other scan does is I've got, I should have left the first one. So the type is stock. And then, let's see, where did I get the rest of it from? No. Oh, there it is. Exchange is NYSE and or it can also be the NASDAQ. So I wanted to add that as well. So what I do is just copy that, paste, and then I would just type in NASDAQ. But it's or, it should be either of these. If I do and, I'm gonna filter out everything. But here, when you're doing an or clause, you have to put brackets around the entire clause. So the scan engine now is gonna look at this and say, okay, I'm gonna pull up all the stocks that are also on either one of these two exchanges. And then I get into, I'm just going to type it. Let's see, today's close. Sorry about the caps. Let me take that off. Today's close greater than today's open. So that's the first clause. And then you're going to say, and bracket again, yesterday's close is greater than yesterday's open. I'll just go one more just so you can see how it's written. And the way you go once you're past yesterday's, you say 2 days ago close, 2 days ago close greater than 2 days ago open, and you just go back as far as you want. Whoops, wrong bracket. So this is just gonna, if I ran this right now, it's probably gonna be a ton of stocks because any stock that has closed above its open for 3 days in a row is gonna be on here. But my scan that that article that the question came in about, I had actually written a scan for 9 days, 9 consecutive days, stocks opening above their closes. I ran it again yesterday, I think, and I believe there were 3 or 4 stocks on there. So it doesn't happen often. But if I run it here with just 3 days, 801. Now, if I add a 4th day, it's probably going to go down to 700 and well, maybe 650. And then 5 days, it might drop to 310 and so forth. But that's one way to look at the AD, because to me, that's not exactly the AD, because if you open at the low and then let's say a stock opens at 20 and goes up to 21 and then comes back down and closes at 20.01, it's going to show up like you had accumulation because you closed above the open, when in fact the AD line would get hammered to the downside because you ended up finishing so far off of the middle. You were at the bottom end of the candle. So, you got to use some common sense too when you look at these charts. And, the stocks that came up on the scan that he or she is referring to, Open Door Technologies was one. Actually, it's not there. It's right here in September. 9 straight days we had hollow candles. Look at the volume coming in and look at the AD line. So I would just say, if you do this scan, follow the AD line as well and make sure you're comfortable that it's also telling you the same story. Another one that did this was Gentex, GNTX, right back in here. I think it was 10 consecutive days. Look at the volume and look at the AD line taking off. That's what you want. Look at what the stock's been doing. It's been unbelievable. So the one I just wrote about was MGA. I think I wrote about it in Chart Watchers, because this one, the volume's not quite as great. I mean, it's definitely greater than a lot of these days, but it's not quite as big as the other two I just showed you. But all three of these stocks are breaking down trends. They're moving up. Here are all your hollow candles. Yesterday, it closed above its open again. So it's now got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 straight days. It's closed above its open. But notice, even though it closed above its open, this was the example I was just giving you. Look at the AD line turning down. So that's why I want to see this going up. I want to see it open or closing above its open, but I also want to see that AD line going up. And so far, I'm not going to be too upset about one day. Every other day it's been going up. So and this is in consumer discretionary, which is a group I like. And then we could take a look at it on a relative basis and see that it's starting to turn up versus the S&P. It's just been so-so versus its group. Whereas if we pull up open, I think this one was weak versus its group, but it started to turn. Yeah, right here. See, it had been downtrending, and now it's at about 5-month relative high to its group, and its group is setting a 52-week relative high versus the S&P. So when I did the pitch, which is another show at StockCharts, I know I do a lot of shows, but when I did the pitch, I had to give 5 ideas. Open was one of my ideas. And in fact, I'm going to give you all 5 ideas when I come back from the break. But we're going to go ahead and I know I ran over, but hey, we got time. If you want to hang around, hang around. We're going to go through a lot of charts here in just a minute. We're going to wrap up ChartFest 2021 in style with a lot of charts. So hang in there for just a couple minutes, but I'll give you my 5 stocks as well when we come back from the break. Be right back. Okay, welcome back, everybody. This is Tom Bowley, Chief Market Strategist of EarningsBeats. If you're just joining us, we're about to go into the lightning round of ChartFest 2021. I hope you've had a good time, with the lineup that we have today and all the charts and all the different strategies and the routines and so forth. The goal here today, number one, was purely educational. We want to make sure that folks know how to use the StockCharts website. Those of you who enjoy my work, I wanted to be able to point out, our approach and our platform and show you a little bit about our website and the processes that we go through, not just what we do, but also how we use StockCharts. So maybe you've gotten some pointers there on how to put together some of your chart lists and some of the things that you do. But it's been a lot of fun. I enjoy these types of events. Otherwise, I wouldn't be here on a Saturday doing this. So I'm really glad that a lot of you have taken the time to join us today. I appreciate it. All right. Let's see here. Let me pull up the charts. Aaron has taken a lot of your requests and we have put them into, she's given me kind of a snapshot here. So I'm seeing them and I'm just going to go through these one at a time, and I'm going to go through them as quickly as I can to give you a very quick look at them. I mean, I can, when you're looking at relative strength, and of course I know a little bit about many of the stocks. I mean, I've looked at these symbols so many times over the years. Usually if you tell me a stock, I know the symbol, or you can tell me the symbol and I know the stock. Occasionally there are some that I'm not as familiar with, but for the most part, I know most of them in the areas that they're in. And so it's really easy for me, because we already do so much research and I already know the stocks that I really like, that when I look at a chart, I can literally look at a chart for about 3 seconds and I can tell you whether I have any interest in it or not. And so that's what we're going to do here with the lightning round. I'm going to go through and give you my quick analysis of what the charts look like, and then we'll go from there. So let me go ahead and share my screen and we will get this started. All right, first question that came up. Let me see if this is this is the chart style I want. First question that came up was AMD. I can tell you, I really like what AMD is doing here. Made a huge breakout, heavy volume, broke out above this prior resistance area, went back, just about tested it. I would say as long as this stock stays above 97 to 100, I'm fine longer term. Short term, I believe we're now starting to trend again above the 20-day. We're about to get that golden cross. AD line, I'd like to see that start to strengthen, at least move up, past that prior high. That would maybe be one of the only negatives. On a relative basis, I think the stock is a strong performer versus the semi group. So I would be a fan of AMD. I'm not saying I would buy it, chase it here. I think what we could have is an inverse head and shoulders, left shoulder, neckline, head, right side of the neckline. If we get a pullback next week to the 20-day, that's where I'd be very interested in AMD. Amazon, we talked a little bit about Amazon. I'm not a big fan because it just isn't doing anything. It's hard to count on its moves. One thing you have to understand about technical analysis, moving averages are great when you're trending. Moving averages are horrible when you're not. So we've been going sideways on Amazon now for over a year. It's been painful if you've been in it holding, because you're underperforming the S&P 500. If you don't believe me, believe this chart. Amazon versus the S&P, it's been going down for a year and 3 months, 15 months. It's been underperforming. Does that make it a bad stock? No, basically it topped there. Actually it topped. This is when the relative strength topped. And that might have actually been a pretty good sign. I mean, I don't really look at that too often, but the fact that Amazon relative to its peers could not break out, even though price action was going higher, may have been a little bit of a warning sign. But anyway, Amazon's been going sideways for a while. Where would I be interested? Well, it's not when it moves through moving averages, because how many times have we done that now for the last year and a half or year and 3 months? A lot. And it hasn't panned out. Moving averages do nothing when you're sideways consolidating. We've got to get a breakout. The thing that's bullish for me is when a stock breaks out, pulls back, holds its moving average, and breaks out to a new high. That did not happen back in July and August. With earnings, Amazon went down. I believe we're probably going to get a big gap back to the upside on Amazon with earnings. It's just a gut feeling of mine. I don't know that I'd be doing a whole lot of investing based on my gut feelings, but sideways consolidation, eventually when we get the breakout and we trend again like we were trending here, that's when I look for these 20-day tests as good support. All right, ASML, sticking with or going back to the semiconductors. You can see great AD. I love that. Price action going up. Even this pullback. You know what? You're going to have pullbacks. We pulled back in March. Was that the end game for ASML? No, it was an opportunity. I think this is creating another opportunity. I believe what we're going to see is a cup continue to form, and I think eventually we're going to make another breakout. So I do like the stock. Relative strength versus semis. Less than a month ago, or right around a month ago, we were at a 52-week relative high. I think we're trending higher, starting to turn back up again. I like the stock. Alibaba. Well, one quick look, no interest. Downtrending. I mean, at least let's get a move up where the 20 gets through the 50. Let's see a successful test of the 20. Let's do something. I mean, we're going down, AD lines going down, relative strength going down. What is there about this stock? Why do I want to put money here? I pass. Let's see, Best Buy, BBY. AD line's been horrible. Now, I don't like to use the AD line as my primary indicator. I like to use it as a secondary indicator. In other words, I'm not going to look at this and say, oh, the AD line's trending down, I'm going to short it. That is never going to be my approach. Now, if the stock's going down in the market, I feel bearish, and this is a weak AD line, then yeah, that could be a short candidate. But I tend not to short much, if ever, very, very rarely in what I consider to be a secular bull market. The worst thing in the world for me is to short a stock and lose money while the stock market's going up, and especially when it's in a market that I believed it was going to go up. There's nothing more emotionally painful for me than to short and lose money in a crazy bull market. So I try to save myself from that despair by not shorting. Yeah, I mean, there are times I see stocks and I was like, man, that looks overbought. And sure enough, it pulls back, but I can't take the other side of it. I can invest on the long side and lose money and still sleep at night. I really struggle when I'm shorting and the market is going up and I'm losing money. Anyway, so the AD line here is weak. Sideways consolidation. I mean, here's Amazon. I mean, it's Amazon. It's the same kind of chart. Do I think that this is a bearish chart? No, but this is a stock that went from 50 to 125. They've probably got supply chain issues, staffing issues, just like everybody else. They've been going through sideways consolidation. I think eventually the stock breaks out, but I'd be waiting for that breakout. Bill.com, interesting. This is one I've actually traded recently, and I'm kicking myself because I didn't hold it long enough. Stock gapped up, and this is one of my favorite trades too. I'm going to shorten the chart so that we can actually I'm going to go with 0, and let's go just 6 months. So you can really get a feel for what's going on here. When a stock gaps up, and this is one of the major, I don't know what the right word is, but this is one of the things that I view so strongly at EarningsBeats. If there's a niche that we have, it's about earnings, and it's about earnings related gaps. In August, look at that massive volume and look at this gap up. Now, if you followed technical analysis for a while, you probably realize that most gaps get filled, right? We pull back and we go back to the prior close. Well, most gaps are not gaps on volume that are heavier than anything we've seen, and most gaps don't continue moving higher like this. So what we're seeing is massive volume, and shorts or market makers who short the opening bell. If everybody wants to buy because of a great report, market makers are on the other side providing liquidity. They're shorting. Market makers, if you know them well, they don't like to lose money, and they don't lose money often. They do lose money, by the way, but overall, they're going to make money. Well, when you get a stock like this, what this tells me is that the demand was so great after the open that the market makers had to cover their short positions and actually go long, because they just had to take losses, just like all of us do. They're not going to just go, full time, full throttle on the short side when the market keeps going up. They're good traders, and they'll take their losses when they have to. Anyway, when you get a stock that gaps up like that on massive volume, when you come back down, these are the two levels: the opening bell, and then when you were selling off intraday, somebody started buying at about 236 or 237, and we opened at 250. Those are two key levels on a pullback. So many people, I think, wait for this gap to fill down at 220. I've been doing this a long time. When I see a gap up like this on this kind of volume, I look for the top of gap to be filled, not the bottom. And if you look, where did we come down to? Right here. And I actually bought Bill.com right around the 250. I don't remember exactly where it was, maybe 255. I got it. And I wrote it up for maybe about $7 or something like that. I don't remember, but I ended up getting out. We were getting near the moving average. Like, I don't know, maybe we go back down one more time. So it was just a, take the profits rather than wait and see kind of a thing. And then it pulled back again, and it never quite got down here, and I didn't buy back. And then I've just watched it go up. Now here you can see a false breakout over 300. So I think right now, short term, maybe we get a pullback, but I love this stock. Absolutely love it. Bill.com is one of the best stocks in the software space. Software is one of the best groups, just breaking out again versus the S&P 500. And look at the AD line, confirming That's how I use the AD line. It's confirming everything else I'm seeing on this chart. So do I want to rush out and buy Bill.com at 296? No, but I believe this could be the start of an uptrend. So if I could get it back at that 20-day, I could keep my stop fairly tight and I might take a shot there. So just, the way I would look at it, I spent a little bit more time on this one, but I thought this was interesting. And I'm kind of bummed right now that I didn't ride this all the way back up to that 300 level. BLNK, Blink. So Blink, there's your downtrend. I'm back to just a 6-month chart, but I'll stick with this for now. Downtrending, AD line downtrending, relative strength is just horrible. Remember, I talked about specialized consumer services when I was breaking down the industry groups for the consumer discretionary area. And I said this is just a weak area. I would stay away from it. Well, not only is it a weak area, but you got one of the weakest stocks in the area. Now, I'm not saying that Blink at some point wouldn't be a great stock. I think it's heavily shorted. I believe it's on our short squeeze chart list. But just because the stock is short doesn't mean it's going to go higher. You need to see a stock start moving before a short squeeze is in play. These moves right here, light volume. I mean, anybody shorting the stock on the way down, they're laughing at this little pop back to the upside. You're not putting any kind of a squeeze on them. They're going to send the stock right back down. So you got to get a breakout on a short squeeze. You got to get it up to like a 3-4 month high so that you begin to put pressure on a lot of the shorts that shorted at lower levels. This is not one of those cases. So Blink, no, thank you. I'm not interested right now. BTU, Peabody Energy. This has been a great trend. I'll be honest, it's an area of the market that I really don't look at too often. Going back to that 100-year chart, you remember when I said I tend to stick with aggressive groups, stay away from defensive groups, and I use energy and materials kind of like as a neutral group, depending on a lot of other things like the dollar and geopolitical and blah, blah, blah. Hurricanes in the Gulf. I mean, all kinds of different things can affect that area of the market. So I would just say I don't specialize in that area. It's not that I wouldn't trade a stock in that area. I have traded energy stocks, but it's not a group that I focus on, which I regret because energy has been the best part of the market of late. But I think over the long term, I think that's, it's been a good thing that I've kind of stayed away from the group. So that's kind of been the theme for me. But looking at the chart, I mean, it looks great. We're putting in higher highs, higher lows. AD line's okay. Relative strength, been weakening versus coal, but that was when it topped. Remember, when you go through a period of consolidation, you're going to lose relative strength. So this is a case where I still think the stock looks pretty good. I'd be, hoping that these moving averages hold and look for a breakout. Breakthrough 20 would be very bullish here. DocuSign. I like the stock. I'm waiting for some confirmation maybe on another move back to the upside. It's in software, which I love. But look at this now, 3 months now, it's been downtrending relative to software. And as it tried to break out the last 2 times, it was losing relative strength. So I like the group. I just think right now there are better plays in the software space than Docu. I'm going to go back to that 1 year and just see the price support areas. Yeah, see, I mean, we had a double top there. So I would have hoped if we had pulled back, we'd have held around 260, 270. And we didn't. We went a little below and we're still failing to break back above the 20. I have to have patience here. And, I think it's one of those things that Dave was talking about with confirmation bias. If you want to buy DocuSign, I could look in here right now and say, look at that AD line. Man, I should buy DocuSign. The AD line's strong. But price action's telling me to wait, and relative strength's telling me to wait. With this being a secondary indicator, I'm going to wait. So I wouldn't be doing anything here yet. Emerson Electric, EMR. This is one been trending higher, pulling back. AD line was very strong on the recent high. Relative strength was awesome on the recent high. So I think we're going through a period of consolidation. I actually think that we may have just bottomed on this stock. I'm just going to show you why. As I look across, I mean, here were all these tops coming in. We broke out. Look, we've been going down testing this bottom. We just put in a little bit of a hammer right here at this level. I wouldn't be surprised to see us move back. Look at the volume coming back in on the upside. I like Emerson Electric. I think this is an interesting stock candidate. Now, if you break down and close below those recent lows, I'd be out. Excuse me. Grab just a little bit of water here. And for those of you interested in timing, I mean, I've got so many stocks here I could look at it. I'm not going to be able to go through all of these, but I want to give you a flavor for how I look at the charts and some of the things that are important to me. And maybe you incorporate some of this into what you do. Maybe you don't. I can tell you that my mindset or my trader's mindset is more short-term oriented, probably than what Dave was talking about. Maybe, and Grayson as well. I think they both tend to hold longer than I do. I'm not a day trader, but if a theme runs out on me, I'm gone. So if I'm in the, riding software up, for instance, and all of a sudden software starts, struggling on a relative basis, I got my stops. I'll put my stops in. I'm getting out if I get triggered. So a little bit different in that regard. So EOG Resources, here was a nice move up, nice trend, maybe a little bit of a cup, not really much of a handle though, but stock's broken back out again. AD line not that great. It's okay relative to its group. I think if I was looking for, production exploration stock, I'd probably look elsewhere. It's an okay stock. I'm not saying it's bad. Volume trends look pretty good as it's come back in. AD line's okay. I just think there are probably others that are out there better than this one. So I'm just neutral on this one. Fastenal just reported big numbers in terms of volume, gapped back up above the moving averages. Still got to get through about 56 and change, 56 and a quarter. So we got a little work to do here. I suspect after this nice breakout of this downtrend that will probably pull back and maybe test those moving averages. So I would be looking there for entry if that's what you're looking for here. Relative to its peers, it did set a 52-week high, or at least test it back in August, and that's where it was setting the highs. It is lower now, though, than it was back then. You can see the price action's gotten back up, but it's not where it was versus its peers. So it seems like its relative grip in this group is starting to slip a little bit. That concerns me a little bit, but nothing beats a high volume breakout. So if we can get that volume coming in and get a breakout, I would be bullish the stock. Next up is LC Lending Corp. This is one of our portfolio stocks, really helping to drive one of our portfolios. And I mentioned earlier, some of our portfolios, generally what I look for is maybe 2 or 3 to help carry a portfolio. Well, this is one that's doing a pretty good job for us right now. Just recently broke out, volume started to pick back up again. AD line's been strong, relative strength. This is versus consumer finance, and it's just broken out to a new 52-week high. The group overall is starting to strengthen a little bit, but not a great group. But you got an all-star in Lending Club Corp. So I really like LC. I think this one looks good. Any pullback, any test of the 20-day moving average would interest me on a long basis. MELI, Mercado Libre, double top right here. It just looks like consolidation to me. That's what I'm seeing when I just first look at the chart. So I'm going to have patience. I either want to get it on a breakout when it's starting to lead. It's not performing very well relative to the group. And again, this is one of those groups, specialized consumer finances, that not doing well right now. So you just have a poor group and a stock that's not a leader, downtrending. I just think we wait. MGA, I mentioned that was the one that was on that scan where we've had all these days in a row, 10 now, 10 in a row, or maybe it's 11. 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. 11 days in a row, the stock is opened or closed above its open. So that's pretty impressive. And it's ended this downtrend, starting to trend higher. Just like Open Door, OPEN, and Gentex, GNTX, which I talked about earlier. If you pull back and get a 20-day test, that's where I would be looking at a stock like this. I like it. Moderna. Well, I don't know how I typed all that in. I guess I had the fingers on the wrong keys. Moderna. We talked about it last week. I actually traded this one. This was best trade I had coming out of Max Payne. So I had bought a little bit of it on Tuesday afternoon, right before Max Payne. We had Max Payne, which was, I think, 343. The stock was down about 310. And I want to say it was 343. Maybe it was lower than that. But when we got that gap up on Friday, I didn't even wait to see what was happening on Friday. I got it on Tuesday for Max Payne issues. It was up on Friday morning. I literally sold at the opening bell on Moderna. So short term, I think we still got a little bit of issues. We got a bearish engulfing candle on Friday. So I think short term, we're probably going to move back to the downside, at least in the near term. and see if we can hold that 300 level. I think we're getting a little bit of a pop, or we got a little bit of a pop because of options, but I don't think it's going to last. It's a great stock, great company longer term, but it went up so much. I just think it's probably needs to consolidate for a while. So I would actually expect it to maybe move down a little bit from where it finished last week. I'm pulling up while I'm kind of rambling here because I'm trying to find this. Actually, Moderna was 326. Facebook was 343. Okay, I got the two of them confused, and it may have helped me in my trading because when I saw Moderna gapping up to 341 or whatever, I was like, that's close to Max Payne, but it was actually Facebook, which did not get up to that level, but did make it a short-term move. That's another chart list and another feature that we have at EarningsBeats. The Tuesday before Friday monthly option expiration, we always have a webinar talking about stocks that could make short-term moves based on option activity. And Moderna was one of those, and it did moved up beautifully into option expiration. All right. Let me get back to my list of stocks. So I think we'll probably go another 15 minutes. How's that sound? That'll be about 45 minutes worth of stock analysis. So let me see how many I can get through in the next 15 minutes. I'll try and pick up the pace so I can try to get through more questions. MU, AD line set a new high. So that's maybe one positive here, but this is a stock's been trending lower relative to the semiconductors, new 52-week low. I mean, why own Micron when you can own AMD or an NVIDIA or even an Applied Materials or SGH, which is one of our stocks that just reported earnings and rallied strongly after earnings. Really nice week last week. So I would pass on Micron just for those reasons. I think you have better options. Occidental Petroleum just broke out above this double top. I like it. It's come down now 5 days in a row. I think the 20-day is where I would, if I'm interested in trading it, 20-day would be a great entry. You got the overall group's broken out. That's good news. Occidental, relative to its group, is near a 52-week high, or was just a week or so ago. So I think it's a pretty good performer. But again, I'm not a huge fan of energy. So the way I trade it, the way others trade it might be different. If I got into it and I thought the 20-day was going to hold, if the 20-day didn't hold, I'd be right back out. I'd take my loss and move on. I don't want to lose money or lose much money in a group that I don't feel comfortable about longer term. So that's just me. Next up, OZK. This is Bank OZK. I think it used to be Ozark, Bank of the Ozarks or something like that. But anyway, Bank OZK. Sideways consolidation. I love the pattern. AD line's fine. The only thing I don't like is that for the last 3 or 4 or 5, 6 months, even, we've just been going sideways relative to the bank index. So you got a lot of banks out there doing better. I like Bank of America personally. I would go with Bank of America. Now, maybe if you get the breakout, watch the relative strength, because you might see that turn back up to about a 6-7 month high. If volume comes in, you make a breakout, then you got a different story. But for right now, I like others like Bank of America a little better. Path, PATH, this is UPath or UiPath Inc. Downtrending. I mean, it doesn't have a whole lot of market action. It went public 6 months ago. So I tend to stay away from these, but having just said it, it's all-time public low. Where's support? I mean, we're downtrending below the 20-day. I personally, I just stay away. And you're in a good group, by the way, software. So the stock performing so poorly in a strong group, I would pass for now. PLTR, Palantir Technologies, sideways consolidating here. Also with the AD line pretty much going sideways, relative strength going sideways in the software group. We are seeing a lot of volume, but it hasn't really translated into price action to the upside. So I question the stock's relative strength. And again, in software, I'm looking elsewhere. Love a stock called DDOG or Datadog, DDOG. That's a good one in software right now. PayPal I talked about, so I won't spend a lot of time here. Just equal highs, rising lows on the weekly chart, just testing the 50-week moving average, by the way. I think I showed this on a daily chart earlier, so let's show it on a weekly chart. See how we're bouncing off that 50-week moving average? I mean, when you look back over the last 3 or 4 years, we've gone below the 50-day only during the pandemic and during the trade war. So with having neither one of those in play right now, I think 50-day or 50-week moving average is a great place to enter. Look at that weekly PPO back down near the center line. I mean, that long-term has been a great place to get into PayPal. So it's one of my favorite stocks that have pulled back of late. So this is one I like. Let's go back to that daily chart and look at Rail. Rail, yeah, downtrending, 80 line going down relative to its peer group. I mean, I don't see anything here at this point that's enticing. I mean, especially when a stock's downtrending and it's below its 20-day, unless I see a positive divergence on the PPO. And even then, there's just too many other good stocks and strong momentum stocks. I don't need to try to catch bottoms. There's just too much other momentum in the market. So it's just not my style. I would stay away from it for now. Riot, blockchain. This is on our list of heavily shorted stocks, but it's trending lower. And this is one that I actually liked. I think it was 2 months ago. I was writing about this. The PPO had gone positive. We were trending up. And I think the point I made was, if we get this breakout above 40, be ready for a short squeeze. We never got the breakout above 40. And we started trending back lower again. It's really important in a short squeeze that you've got to be squeezing the shorts. If anybody is shorting at 40 and you don't break through 40, you're not putting any kind of squeeze on. They're not even losing money. So major resistance has to be taken out. So right now, Riot, I think it's just in a downtrend. I would not be interested in it at this point. Solar Edge, it's in renewable energy. Renewable energy is starting to catch fire again. So I think this is an interesting play. We did have a recent breakout above what, 8-month relative or 8-month absolute high or absolute price resistance. Got a breakout there. I think if we pulled back to the 20-day, I'd be interested here. This is a group that has just started coming off a bottom. I'd really like to see it take out that June relative high. But if it does that, moves to about a 5 or 6 month relative high, the group, then I'm going to start looking for leadership in the space. Right now, I mean, Solar Edge was uptrending for several months, just kind of going sideways right now. So look for that to turn back up again. But if we get that breakout in the group on a relative basis, I think this one looks a lot better. Skills, SKLZ, stock's been in a downtrend for a while. I believe this is on our short squeeze chart list now, but we need a breakout. Again, what shorts are we threatening right now? The ones that shorted down here, probably not that many of them. I'd be worried about all the guys and gals that shorted July, August, and September on the way down. Because if they're shorting from 17.5 down to 12.5, if the stock moves from 8 to 9, who cares, right? You're not putting any pressure on anybody. We need a story. We need something. We need volume. We need a break above moving averages. We need to start getting some of these shorts underwater. Otherwise, short squeezes don't work. They don't work just because there's a lot of short interest. They work because there's a lot of short interest and you start technically doing something to the upside that makes everybody scream fire in a movie theater and all want to get out at the same time. And there's only one door at the bottom of the steps. That's the kind of panic you want in a short squeeze, not, not trying to catch a bottom. I do not bottom fish in heavily shorted stocks. I think that is a way to lose a lot of money. SLI, Standard Lithium. Love the breakout. It's not really my style to invest in lithium, but AD line looks good. Price action, volume trends. The relative strength is not going to work other than with the S&P 500, but it's breaking out. I mean, I don't see any problem. It's just, it's very volatile. So if you're somebody who's trying to manage a portfolio, in your retirement and you've got, you have no way to build back your retirement. I'm not going to be putting much money into a SLI. But again, if you're somebody with a gambler's mentality, this has gone up many times now, but 6, 7 straight days, 8 days in a row or whatever. You got a double top here at 9. So I think a pullback to 9 is what I'd be looking for. And you might say, oh, it's 11. It can't possibly go back to 9. Oh, I can assure you it can go back to 9. Here it was 8.5 the same day. It was back to 5.5. So this stock is going to move or can move very, very quickly. Snowflake, and I'm going to do maybe about 3 or 4 more, and then we're going to wrap this up. Snowflake AD line looks good. Price action trending higher again. I do like what it's doing here in the short term. You can see relative to the S&P, it's trending higher. Relative to software, it's been trending higher. So yes, this one is definitely on the improve. And as long as we keep this trend in play, that was one thing that Dave Keller focused on earlier during his presentation was identify the trend. That's the first thing. I think it's pretty clear now we're trending higher. We were trending lower. Now we're trending higher. When do you want to own it? You want to own it when it's trending lower or when it's trending higher? I want to own it when it's trending higher. I think pullbacks are viable in an uptrend. SNPX, lots of tops coming in here at 14. So that's the first thing that just sticks out at me. We got to get that breakout at 14. Pullback, if you're assuming that this is an uptrend, we moved up, tested the 20, bounced to a new high. I could see you using this as an uptrend. So that means I'm either going to buy on the 20-day or I'm going to buy on that breakout at 14. Square. Square is kind of in that space with PayPal. I mean, I like Square longer term. Short term, it's sideways consolidating. AD line, sideways consolidating. Relative strength, sideways consolidating. You're just sitting there waiting. And if the market keeps going up and this stock doesn't, it's opportunity cost being wasted. That's kind of the theme here. So I'd not do anything with it right now. Long term, and I've said this before, I'm talking from a short-term trading perspective. These stocks are sideways consolidating. The Amazons, the Squares, PayPals, all these stocks, long-term, love them. Short-term, PayPal, because I thought, that 50-week test, I like it. But short-term, a consolidating stock, I tend to stay away unless it's right at support. Let's do two more. Suncor didn't quite get up to that $25 resistance level, but it is trending higher right now. That AD line bothers me. It's in energy, obviously, which I'm not I don't like to trade energy personally. I just don't follow it enough from a fundamental perspective. Greg Schnell, and I would tell everybody this, if you're going to look at trading commodities or energy, Greg, I don't know anybody fundamentally who knows more about those issues than Greg. He lives in Canada, lives and breathes commodities and energy. He knows this stuff like the back of his hand. He'd be the one I'd be following in terms of energy and materials. I think he does a great job with that. But yeah, I mean, this one is picked up a little bit recently on a relative basis, but it's up near key resistance. So if I was in it, I'd be probably winding down a position to see if it actually could make the breakout. All right, last one we're going to do here. I'm going to pull up Tilray. Tilray, I mean, the AD line's very weak. Price has been going down. I will let you in on a little secret. I'm going against every fiber of my being a technical analyst, and I've been accumulating Tilray. Not a huge position, but as it's been falling off, I've been picking up a little bit more, and I'll show you why. A lot of the volume on Tilray came in after this gap up right here. I mean, we had a couple big days over here, but when you look at this huge move that the stock, when it ran from 10 to 70 or 65, or whatever it was, look at the volume that came in over that month. That was when the meme stocks were in: GameStop, AMC, Tilray, just a lot of stocks. Some of them stood up, held up there. Others drifted lower. Some kept going higher. But Tilray has worked its way all the way back into what I consider to be a fairly big gap support zone. So I'm down actually pretty good on this one right now. But I'm in it for this gap support. I'm hoping that at some point I wake up on a Monday morning and there's an announcement. And all of a sudden, this thing goes to 18 in a week. That's what I'm hoping. Maybe I'm just dreaming, but that's the idea. And this is not the way I trade and invest, by the way, usually. So it's kind of weird, but I just happened to look at it one day and I looked over here and I saw that volume coming in. I was like, I think buyer's going to show back up in this range. So it's one of the few non-technical trades that I made. And I call it non-technical because it's non-momentum. And I'm much more of a momentum trader. Well, I am a momentum trader. So anyway, Tilray, just full disclosure, I do own this one. Can't exactly explain to you why, other than what I just did with the gap support. But this is one normally that I would wait for the actual break above the 20-day. And at this point, with what I'm down, I wish I had waited for the breakout above the 20-day. All right, that is going to wrap things up. I mean, we've been at this now for almost 4 hours. I know for those of you, I wish I could give a prize out to everybody who was in here for the entire 4 hours. I wonder how many of those of you are there out there. Anyway, it's been fun. You know, we want, again, I think the objectives were met. Dave and Grayson both did a fantastic job of showing you how they use the website at StockCharts, the platform, the chart lists, and so forth, and their routines, not just the chart list, but how they go through their routines, looking at the market, looking top-down approach. I've given you my take on it, the way I trade, and also what we built here at EarningsBeats to help folks trade. And so hopefully this was an eye-opener and helped you in some way, whether it was maybe just you learned something, maybe you'll incorporate some of this in your trading. Maybe when I went over my 100-year chart, maybe that helped you. Maybe you're thinking bearishly all the time. Maybe that'll help you try to look at the other side. Whatever, you know, we did to help, or I hope we did to help, is great and is well worth it. But that's going to be it for me. I want to thank Erin, who's hung out all day with us here as well. She's been helping me feed me all of these stocks and so forth. And so I know it's been a busy day for her as well. So thanks, Erin. And thanks to all of you for taking your time out and being here today. I hope this helps in your trading and investing going forward. So take care, everybody. Appreciate you joining us here for ChartFest 2021. Like I said, we got a couple of member-only events coming up early this week. Give us a shot. We'd love to have you come in. 30-day trial, no cost. You do have to give us a credit card just so we can get you set up in our system. But we are going to reach out to you before your 30 days expire. We're not going to sit back and say, boy, I hope they don't realize their 30 days is coming to an end. We actually initiate contact with all of our trial members to see if they want to upgrade at a lower cost on an annual basis, to let you know that your credit card is about to get hit. We don't sneak anything past anybody. If you don't like our service, go elsewhere, please. We're not for everybody. I know I'm not for everybody. Everybody has a different take on the market, and that's fine. So, but we'd love to have you check us out and check StockCharts out as well. Because if you do us both right now, 30-day trial, if you're not a member of either, you can check both of us out. You can download our charts. As I mentioned earlier, the gifts that we're going to give you, we're going to give you a lot of chart lists out of Grayson's account, Dave's account, and my account. Well, EarningsBeats account, to give you some idea of how we organize our work and hopefully give you some trading opportunities and, better ways to look at the market. So give us a shot. We'd love to have you come on board. That's it. I'm done rambling. I was trying to make it a full 4 hours. Didn't quite make it, but pretty close. Listen, everybody have a great rest of your weekend. Thank you so much for being here and listening to our shows or read our blogs and so forth. We'd love to have that support. Take care, everybody. Yes.
Quick question for you. Did you give your 5 stock picks?
Oh, no, I didn't. I forgot to ask Grayson and Dave, and then I almost forgot and rolled out of here without giving them. Well, I think you're probably going to know some of them because I've talked about some of them. And if you read my blogs, you're going to probably know. I've got one stock open door. I love what this chart's been doing. I just like this downtrend. I like the move to the upside. This is the one that had those 9 consecutive days of opens above closes, closes above opens, and the volume coming in, the AD line soaring. Relative strength's been picking up. It's in a great area of the market. So let me pull this up on a relative chart basis. Thanks for reminding me of that. I would have really been bummed if I'd remembered later. And anybody who left early, I guess they'll go back and get this. I'll put it in the chart list so everybody will have it. But there you can see open relative to its peer group. So see how it had been very weak. Now it's strengthening versus its group. Look at its group. So you've got, this is one of the strongest areas. This is real estate services, one of the strongest areas in the stock market. And open, which is showing a lot of accumulation, is now starting to show relative strength versus that group. So this is what I look for. And when I think I wrote about it right in here, and I said, if we got to pull back to the 20-day, that was an opportunity. Well, we've already gotten one of those and then we bounced, but we'll probably get another one. So I would just keep this on a watch list and keep it in mind. Next up, I'm going to give you Tesla. I'm just a big fan of Tesla. I love what's going on with the autos right now in terms of their strength picking back up again on a relative basis. Like I said earlier, we just broke out or on the verge of breaking out above that prior January high. So I think autos are ready to make a huge move. Tesla reports this week. That's the only downside. If you get in, they come in, and for whatever reason, they may have a great report and still go down $100. We don't know. So you got to be careful right before the earnings report, and you've got to make that gutsy decision whether or not you want to hold the stock in earnings. I can't give you any great suggestions. I don't even like the word advice, but I don't even have any suggestions for you on that. You just have to look inside, look at the mirror, and decide if you're willing to take that risk. It's the riskiest day to hold a stock into its earnings report. But I love the company. I love what I believe. I'm going to make a prediction here. At ChartFest, the inaugural ChartFest 2021, I'm going to make a prediction here. You might think I'm crazy. I think within 5 years, Tesla will surpass Apple in market cap. I think Tesla will be the highest market cap company in the world within 5 years. And I say within 5 years. I don't even know if it'll take 5 years. I believe when you get this next breakout, you're going to probably find another quick double in it. And Tesla is almost a $1 trillion company now. And so you think, well, it can't double. It can't be a $2 trillion company. Well, their earnings can grow very rapidly. And when you're in a low interest rate environment, I'm telling you, the valuations can explode. So I would definitely be keeping an eye on Tesla. A lot of folks don't want to get into it, haven't wanted to get into it. And my version of Tesla was Amazon. I went years and years. I could not buy Amazon. The CPA inside of me, watching them pile up losses quarter after quarter, is like, this company's not worth it. Well, the market knew a lot more than I did. And that's one lesson that I've learned over the years, is the market knows a lot more than I know. And so when I see Tesla outperforming and performing the way it is, I don't know. I think we got a big winner here still going down the road. So that's stock number 2. Stock number 3, this is going to be a smaller wireless company that you may have not heard of. It's actually on our short squeeze chart list right now. And I like the stock. They came out with news. Remember I was saying you need news, you need something to jumpstart a short squeeze? They came out with news that they were raising their guidance well above prior estimates. And you want to talk about shorts kind of getting a little scared? That was the first pop up to $19. I think the pullback to the 20-day created an opportunity. I'm in the stock right now. I own it. I don't own open, by the way. I love the stock. I'm trading it. I've been trading and holding Tesla. I have a position I've been holding, and then also I have a trading position. So as Tesla goes up, I sell. If it pulls back, I get back in. Open right now, I'm completely out of it, but I want the stock to pull back to the 20-day so I can get back in. I love the stock. GoGo, I'm actually in right now, so I am still in this one. The fourth one I'm going to bring up is an ETF, the IYT. I've been talking about transports. I kind of had a couple false alarms back in maybe August, September. It looked like it was starting to go and then pulling back. Transports love the month of November. Let me show you the seasonality on the IYT. So if we go to November, you can see, okay, the last 5 years, the IYT has gone up every year, and it's averaged going up almost 7% each of those years in the month of November. Look at every other month. There's nothing even close. So let's go back to 6 years. Oh, wait, 100%. Now it's 7.9% average. 7 years, 83%. So we went down 1 year, 6.5% average. Now 86%. So 7, or I guess that's 6 out of 7 years because we haven't had November of this year yet. 6 out of 7 years up, 6.4% average. Now we're 7 out of 8 years up, 6% average. Now we're 9 out of 10 years up, or excuse me, 8 out of 9 years up, 5.5% average. 9 versus 10 years, 9 out of 10 up, 5.1. 10 out of 11, 4.8. I mean, do you see what's going on here in November? And now let's go back and take a look at that chart again on the IYT. And we're just starting to break out. The trend is changing. Going back again to what Dave said, identify the trend. The trend was down. Talking about it in August and September when I did probably was a little bit premature. I don't think it's premature anymore. I think we are moving back to the upside. I love this breakout on the PPO back above center line. I think IYT is an interesting area of the market to be in, and it's an ETF, so you can spread your money around different areas of transportation. And then the fifth one That's a good question because I wrote down 4. Tell you what, I'm going to just quickly look. You know what? My 5th one I'm going to throw in PayPal. I like PayPal. I love where it's sitting right now. It's in a little different area of the market. And I think this opportunity is pullback from 310 down into the 250s has given us a great opportunity. I like PayPal. So there are your 5 stocks from me. So now I can wrap up the show, and I will try to make sure that Grayson and Dave also give you their 5 picks, because somehow I managed to let them get out of here without giving you their 5. But anyhow, again, appreciate everybody coming by. Love doing this. We'll be sure to do it again next year for another ChartFest. And if you want, send us some emails, even if you're not a member. We'd love to get some feedback from you. You can email us at support@earningsbeats.com. If maybe you're listening to this on the recording later, and you want to just share some thoughts with us, how we can make it better, some of the things you got out of it. We'd love to know. We love the feedback, both positive and negative. Love to hear it. All right, everybody have a great rest of your weekend, and hopefully see you on my Trading Places live show on Monday at earningsbeats.com. Happy trading, everybody. Take care.